I remember, like, I never really approached the door left hand, and I didn't know.
You know, they should.
And of course, it came with her mask. Of course, I know there's a crowd of place. So.
So it's a 30-minute oversight. So basically, I've been to see 10 minutes and then.
Okay, let's get started. Just for those that are new in the room, I wanted to remind you of the kind of rules of engagement. There's 45 minutes for each paper today. We have kind of light questions throughout, and then we ask the speakers to end a few minutes early so that we can have some questions at the end as well. 4 papers this afternoon, and Antoine is going to start.
Thanks. Well, thank you so much for the opportunity to present this new paper that's titled Pre-Trends Ahead of Monetary Policy Surprises, Recovering the Response of Corporate Investment. That's joint work with Peter and Kunal, who are in the room, and David that's joining online. And we're super excited. It's the first time we present this paper at a conference. Super excited to hear about all the comments you may have. So the motivation for the paper is to revisit very important question, which is how does monetary policy affect the economy? Despite its importance, which I don't think I really need to motivate in this room, the answer to the question has been empirically hard to pin down. The main obstacle is identification. Monetary policy reacts to the economy. So monetary policy actions are correlated to the very business cycle forces that are driving the outcomes we like to study. One major methodological advance is the high frequency identification of monetary policy surprise, the idea being to isolate interest rate changes in a narrow window around FOMC statement release, where the FOMC statement release plausibly dominates the new space. This allows to pin down the clean effect of monetary policy on high frequency outcomes, such as asset prices. But I want to highlight that there's a sort of a frequency mismatch because the interest rate surprises are identified in a narrow window of typically around 30 minutes, while most of the outcomes that we like to study are only measured at lower frequencies. So think of investment output and so on. And so a common fix, which large literature has followed, goes in 2 steps. In the first step, what you do is you aggregate the high frequency surprises to match the frequency of the outcome that you'd like to study. Think of corporate investment that you can observe every quarter by summing over the narrow window surprises over an aggregation window that matches the frequency. Now, in the second step, what you're going to do is regress the macroeconomic outcomes, so things like corporate investment, on the aggregated surprise series, and read the coefficient in this regression as the causal effect of monetary policy on the outcome. Now, obviously, this 2-step approach changes the identifying assumption. In high-frequency analysis, you essentially need only the monetary policy surprise to be unrelated, or the FOMC announcement to be unrelated to other relevant news that would arrive within this narrow window of typically 30 minutes. However, when you turn to low-frequency analysis, you're going to need the aggregated series of monetary policy surprise to be orthogonal to all business cycle forces that are unfolding within the aggregation window. And that's exactly what we study in this paper. We unfortunately find that the stronger identifying assumption does not seem to be backed by the last 40 years of data, in the sense that monetary policy surprises are endogenous to the business cycle. And in particular, easing surprises typically occur during easing cycles, and vice versa for tightening surprises. So this shows up graphically as very large pre-trends in interest rates ahead of policy surprises that correlate with the surprises. Now, controls included in different specifications do not seem to fix the problem. Either these large pre-trends survive or the surprises do not longer move interest rates contemporaneously. So in other words, the relevance phase. Now that does not undermine the use of high frequency identification for the study of high frequency outcome, because it still remains plausible that no other relevant use that would matter for interest rate would arrive in this very narrow window. So as a general, first principle solution, we propose to estimate the effect of monetary policy on high frequency outcomes, typically asset prices, and then bridge these estimates to the low frequency outcomes that we care about, like investment or output, using a model. And so in the paper, in the talk today, I'm going to walk you through one such approach that we follow to recover the response of corporate investment. And the bridge that we're going to use is Q theory. In the first step, we're going to estimate the effects of monetary policy at a high frequency on firm valuations. In the second step, at low frequency, in a separate exercise, we're going to estimate the co-movement of corporate investment with firm valuations. And under Q theory, that's going to be enough when combined to recover the response of corporate investment. That is because under Q theory and the assumptions, the few further assumptions, that's going to be providing sufficient statistics. Yep.
Seems like there's a third assumption to buy into, which is that the predictable part of monetary policy is either inconsequential or certainly not the bigger effect of what monetary policy does. So does your model rule that out per se, or is there what's the evidence that you think supports that assumption?
Yeah, that's a super important question. That's sort of independent of the first part of the paper. So I'm going to walk you through first to the first part of the paper. I'll have some evidence that makes me feel confident that you can rather reliably use high frequency identification to study high frequency outcomes. So now I'll give you. I don't have any model evidence, but I have empirical evidence consistent with this. So sorry,
if you think of these as IV instrumental variable questions, then systematic question, you're just looking at what's the effect of the change in interest rates. I had an instance, there may be better instances, but I had one.
Yeah. When it comes to valuation, exactly. Yeah, for valuations. Yeah. Yep. Sorry, there was a.
Yeah, I just wanted to second what Eric said. I mean, I think in your model, this shock is going to be an indicator of what's happening with interest rates more generally. So it would be informative about the effect of interest rates beyond the shocks.
It may not be the question that the FOMC cares about.
No, it will be informative about the effect of systematic monetary risk.
May or may not. That's the model.
In that model.
Yeah, so I'll have evidence that will address that. So let me first highlight the problem. And so what's nice, but of course comes at a cost under Q theory assumption, is that the second step is also legitimate in the sense that I don't need monetary policy surprises to back up the co-movement of investments with firm valuations. Whatever under this assumption, whatever drives firm valuation co-moves the same with investment. So Q theory comes with a lot of caveats, but we think it offers a natural first step because it gives a simple and transparent benchmark, but also, as I will be able to show you shortly, it seems to explain investment by US public firms surprisingly well. Now, combining these two steps, we obtain that a 1 percentage point tightening in the short rate is associated with a drop of annual tangible corporate investment by about 0.38 percentage point of GDP. That's for the representative sample of non-financial, non-utility US public firms. So the outline for the talk is going to follow these two parts. I'm going to first talk about the problem and then guide you through our proposed solution. So now on the empirical setup, we're going to do a very simple exercise that's going to be based on using as a baseline monetary policy surprise, the latest iteration of the statement, so-called statement surprise from the Fed's new event study database. That's defined as the first principal component of money market future changes in a narrow window around the FOMC statement release of around 30 minutes. We're going to scale the surprises such that a 1 unit change in the surprise is associated with 1 percentage point increase in the 1 year treasury yield within that narrow window. And our sample is going to consist of surprises around scheduled FOMC meeting between 1994 and 2023. The exercise that we're going to run is a simple series of local projections. You should think of it as an event study with a continuous treatment, which is the tightening surprise, specifically for each horizon H, that's going to be both positive and negative. We're going to study the change in the, we're going to regress the change in the 1 year yield from the day prior to the FOMC announcement up to H day or back to H day before the announcement. And in the, I'm going to show you the beta H, which are going to trace down the relative yield path ahead and following a 1 percentage point tightening surprise relative to the yield path you would see around a no surprise meeting. I'm going to scale down coefficient, normalize to be 0 on the day prior to the announcement. I'm going to start with this daily regression, and then I'm going to zoom out following the two-step approach that I highlighted earlier. Now, let me just start with what I think I would like to clean event to look like with no prior. What I would like to see if surprises were truly surprises is no pre-trend in interest rates. That's this flat red line. And then I would like to see a jump on at the time of the surprise. That is that for the surprise to be relevant, it should move interest rates contemporaneously. And then it's becoming a bit harder to make precise assumptions about how the persistence should look like. But you can imagine it follows one of these paths. Now, let me jump to the data. Here is the daily event study on the 1 year yield from 7 days prior to the surprise up to 20 days after the surprise. What you see is roughly what I just showed you under my null hypothesis, which is that you've got no pre-trend, a jump on the day of the announcement. That's roughly equal with a coefficient equal to 1. That tells you that the surprise is surviving the day, that it persists over the day, and then some persistence over the next days. Yeah.
But to be clear, you're not paying back.
No, I'm not. It's just a projection. Yeah. But the pre-trends up here, once I extend the window, allowing on this graph for 20 days prior to the announcement, you can see that a pre-trend drift in the direction of the surprise over the prior 20 days to the surprise, and that's building up to be roughly the size of the surprise. That is very consistent with a large literature that have shown that recent news ahead of FOMC announcement predict the sign and size of surprises. Now here, the sort of new feature is that it shows up directly in the interest rate path. But most importantly, the novelty here is that once I zoom out, allow for 240 trading days prior and post FOMC announcement, you can see that this is not just some form of short-run momentum. You've got a pre-trend that's building up over roughly the entire prior year and summing up to roughly 10 times the surprise and its effect on the day. So this is telling you that the surprises are correlated with slow-moving conditions that are observed in yields, but are definitely related to business cycle conditions. Now, same exercise as the daily exercise, but now at the monthly frequency. So I'm doing the frequency is now monthly, and the aggregated surprise is that the monthly level. You can see that the pre-trend survived the aggregation. Again, the aggregated surprise monthly series is correlated with slow-moving business cycle condition and a path of yield that builds up over roughly the 12-month leading to the surprise. Now, same exercise, at the quarterly horizon, which is roughly the horizon that is typically used to study, for instance, the response of corporate investment, you can see that the identifying assumption is becoming harder to defend in the sense that, again, the quarterly aggregated surprise is correlated with a large pre-trend in yields that is indicating slow-moving changes in business cycle conditions.
It reverses and was that like for about 6 quarters, it looks like it's going up and going down. Do you have anything to say about that?
Yeah, so I could have plotted the same event study, but putting on the right-hand side the raw 1-year yield change. So that is not the aggregation of the surprises. I would have obtained a graph that would have looked very similar. And that's just indicative of the, I think this is just indicative of the interest rate cycle. But roughly, of course, you would get very different y-axis on that graph. Now, I think one very natural reaction to this business cycle endogeneity problem is to try to control directly for it. So here I'm plotting the same quality event study line for the 1-year interest rate. And I'm going to add controls. I'm going to start with the Bauer and Swanson list of controls that have been shown to predict monetary policy surprises using news ahead of FOMC meetings. And I'm also going to add a line that's going to control for 4 lags of real GDP, unemployment, and inflation. And roughly what you see here is that either of these orthogonalization methods for the surprises are not going to be able to remove these pre-trends. And in fact, once you control for the Bauer and Swanson controls, there's very limited effect contemporaneously on interest rates. Now, I could also directly control for the pre-trends that I just showed you in the previous graph by including 8 lags of quarterly yield changes. This just mechanically kills the pre-trend. But once I also account for the other control sets, like the Bauer-Swanson controls, the macroeconomic controls, the relevance of the aggregated orthogonalized surprises just falls. And in fact, it looks like a tightening aggregated surprise is predicting interest rates to fall in the contemporaneous and future quarters. So just to summarize, controls do not seem to fix the problem. Either pre-trend survive or the aggregated surprise lose their relevance, and or both at the same time. Yeah.
I want to make this bias, right? So it sounds like the surprises are picking up. We didn't know if the Fed was going to tighten at this meeting or the next meeting, but we're definitely in the tightening part of the cycle. And the surprise is they tighten today, and they're tightened at the next meeting. So that would suggest that these regressions that you're criticizing with real stuff on the inside should have been underestimating the magnitude of responses, because the tightening is happening at a time when the economy is generally moving, and that's why the Fed is tightening.
Yeah, the next slide will very directly address your point. So let me move to it. So and no, so you can think of an analogy between the recent news that are incorporated in the into the Fed's decision. But here you can see that like news that date back as long as 1 year before or correlated with the quarter.
We didn't go back more than 1 quarter because we thought that would be going back too far, but you're saying, okay, maybe we should have gone back 2 or 3 quarters. That's fine.
Yeah, that's
In
one.
principle, there's nothing wrong with it.
No, there's no. I'm totally on board with you. Another way that I like to see the problem is that is really showing this slow-moving business cycle endogeneity, is to look at the estimated effects on the macroeconomic outcomes themselves. So here I'm projecting unemployment rate and log real GDP on the aggregated quarterly surprises. I'm starting with the raw surprises. And what you can see is that there are large pre-trends ahead of the surprises in these two outcomes. Unemployment rate is falling ahead of a tightening surprise, and log real GDP is rising ahead of tightening surprise. Now, the estimated responses, the positive horizon, very much look like continuation of these pre-trends. When following an aggregated tightening surprise, you get unemployment rate to continue falling and the log real GDP growth to continue rising. So this is indicating that it is unlikely that this is capturing the causal effect of monetary policy, but instead the continuation of the pre-trends. Yeah.
So just as in terms of the economics, would you say, the main sort of finding is that full information, rational expectations is a bad starting point for the identification here?
Yes, it is. I'll get to that, but yeah, I'll get to that in just about a minute. Now what I can do is just show you how these estimated responses of the effect of monetary policy on these aggregate outcomes vary when I orthogonalize the surprises before the aggregation. So I'm starting with the balanced ones on controls, adding macro lags, yield lags, or all of them at the same time. What you can see is that the answer that you get very much depends on the control set. In other words, the interpretation you have of the transmission of monetary policy to these outcomes is very dependent on the control set. Now, one, I think, deeper issue is that so far we don't have a clear idea of what's the source for this endogeneity problem. So it is likely that we are not controlling for all of the endogeneity issue with these sets of control. Another way to quantify this fragility is just to compute from a very conservative perspective, Oster bounds on the estimated effects of the surprises on these outcomes. And what you obtain is very large bounds, which do not pin down the effect of monetary policy, the sign of the sign of the effect on these outcomes. Yeah, so a couple of things. So one thing that you could see from the previous graph is that there's low relevance with f-stats of around 7 for the yield lag controlled specification. We think of it as could be a first step moving forward. The other one is that if you look at the response of the unemployment rate and log real GDP to these orthogonalized aggregated series, that's the yellow line here, you see that following a tightening aggregated surprise, the unemployment rate is falling, real GDP is rising. So that's another, based on prior, that's another reason to be dubious about this next step.
It's one thing that maybe these surprises are informative about something other than a genuine monetary policy. Right? It's another thing that, maybe when you were doing the time aggregation, you were missing the exact timing of events. So this is the Mars problem, right? But then the third one that we're pushing is surprises themselves are forecastable, right? And that means there's this, what we think is general and efficient part of it, that's leaving you a whole bunch of money lying around. In particular, when you say the yield change itself isn't encompassing the other information that was available at the time you were measuring the yield change. There's a whole bunch of markets that are collectively failing.
So you say on the second part, I think you have 2 points. On the second part, you're saying that the yield change has more spans more information than the other controls. Yeah,
I expect to see that under any form of efficient.
Well, I mean, many of these things are very hard to learn, I think. So the notion that even though we see this as being forecastable ex post, that it's obvious ex ante is, I think, does not follow even close to follow.
So, yeah, all of this is in sample on a relatively small sample of 30 years with quarterly data. One thing you can do is try to look at, what would be the Sharpe ratio out of sample from following a strategy which would be to sell the 1-year bond when interest rates are rising, And the Sharpe ratio of that strategy is very small. That's like 0.4. That's not much more than sort of the risk compensation you would get from investing in the S&P 500. So ex post, it is characterized, a positive tightening surprise is associated with a large pre-trends, but there's a lot of error around it. What I want you to focus on is the fact that these pre-trends are large relative to also the interest rate movements around the surprise, and that the pre-trends in the outcomes are also large relative to the response of these outcomes.
This meeting or next meeting, that doesn't violate any market efficiency, but it has technical application, which is on the day that you see a positive surprise, you should see some offset in what happens to the futures market for the next meeting.
But I think it's wrong. I mean, if you take the easing cycle in 2001, it's negative surprise after negative surprise after negative surprise. It's not a timing issue, I think.
Yeah, these are not funds rate surprises. They're 1 year principal component surprises. So if you type this meeting or next meeting, it's not that 1 year.
Yeah, it seems like the market just underestimated the extent to which the Fed was going to move over this whole period.
Which is very much, that's your story. That's
The market just underestimated that it's going to respond.
That's I think the most reasonable interpretation. Now our point is going to be that, you know, regardless of the interpretation for identification, the fact is that a positive aggregated surprises is correlated with slow moving conditions, and that's making it harder to interpret the validity of the or the empirical validity of the identifying assumption. Now you may, yeah. They are, but that's not for the quantitative pre-trends that I showed you earlier, that wouldn't be enough to explain the graph. Yes, that stays. Again, the significance of the pre-trends is telling you that there's also a lot of slow moving conditions that are feeding in yields between meetings. Now, you may wonder that this is specific to, you know, the aggregation over one specific tightening surprise. So we have been running different tests over a large collection of the most commonly used high frequency surprises. In the first column, I'm showing you the relevance, so whether the aggregated quarterly surprise is moving interest rate in the same direction as the surprise, and you can see that most essentially all of the aggregated series are passing a very high or passing easily the relevance test. They all are associated with a large F-stat. Now, on the pre-trends, I'm showing you the p-value on the coefficient in the regression of the aggregated surprise on the last yield change, last quarterly change in yield. And what you can see is that all of the aggregated series are suffer from the same problem as indicative of the low p-value. Now, you can also look at orthogonalized shocks. The pre-trends do not disappear, but you can see in the first column that the relevance of the aggregated series fall below reasonable level. Now, on the interpretation, but I think we covered a bit of it. What this is saying is that easing surprises are embedded in broader easing cycles, and vice versa for tightening surprises. You know, one possible interpretation, very much in line with Eric and Michael's work, is incomplete information. The Fed is responding to a business cycle, and investors are learning about that rule over time. And so, starting from a different prior, you can give rise to this in-sample ex-post predictability. Now, I really want to emphasize that, you know, regardless of the interpretation, the surprises are correlated with the slow-moving business cycle conditions, and they make it hard to interpret the responses of outcomes as, you know, the causal effect of monetary policy. Now, I'm repeating myself, but low frequency estimated response of low frequency outcome are likely to reflect the continuation of business cycle trends, not the causal effect of monetary policy. Now, at the estimated effects on high frequency outcomes suffer less from that problem, in the sense that it is unlikely that business cycle news are arriving in the narrow window around the FOMC statement release. And so what I'm, one way to empirically, test indirectly this assumption is to look at daily event studies, so rather narrow window around the FOMC surprise in different asset prices. So here I'm showing you the 1-year yield daily event study and the S&P 500 return event study, and stacking up different event study lines with daily surprises that are orthogonalized to different sets of controls that we've shown in the low frequency analysis were responsible for large shifts in the responses that you would observe. You can see that these daily event studies are rather insensitive to controls, and in particular, the narrower you look around the FOMC statement release. And so this, we view it as indicative that the business cycle contamination that I documented earlier is unlikely to spill over to rather high frequency analysis. So what I'm going to name high frequency very in a wavy way is going to be, for example, looking at 2 to 3 days around the FOMC statement.
Think about the Delta interactive where they are controlling for all of the previous months and not the controls, but the subsequent variables look reasonable if you want, like interest go up, investment goes down, like why are you getting so the result is so different in the previous table?
Yeah, so let me just show you. The point here is that whatever control set you're going to include is going to change drastically your conclusion over the estimated responses. So of course, you can think in some way that these VARs are going to be some form of, are going to give you some identification that's close to some form of auto-organization methods that I'm doing here. But nevertheless, the identifying assumption is going to be that your instrument is going to be, should be orthogonal to the, innovation in the other variables. And that's not going to be satisfied if you think that the pre-trend that I showed you earlier, which are not controlled for by most methods, and in particular by lags of macroeconomic outcomes, if you think there are continuations of this pre-trend, that identifying assumption is going to be violated. Now, of course, some of the, in some control set, you can find an estimated response that at positive horizon is going to look reasonable, but the problem is that you still have it's not going to erase the pre-trends. Yeah.
Could you clarify the distinction between surprises and shocks here? It seems that you are very careful in terms of talking about surprises, but when you go to do the VAR, you care more about shocks, and you are measuring something from asset prices, which is a complicated bundle. I understand you use relatively short term, but still you have the belief component in there. Some people have been alluding to that. So maybe you can clarify just how you think about these two, shocks versus surprises in your results.
Yeah, so as to how we're concerned, here we're really not trying to push too much on the interpretation of the estimated effects based on the aggregated surprises. Here we're just narrowly trying to tell you that the identifying assumption that's underlying the estimated effect of the surprise, not necessarily the shock, on the outcomes is unlikely to hold. But we can discuss that more. Now, so sorry, just to conclude, we are pretty confident about the fact that the business cycle endogeneity problem that I showed you so far is not contaminating daily frequency identification. Now, I just want to point out one thing that will be useful for part 2, which is that the S&P 500 return seems to respond to monetary policy surprises over more than a day. So for that reason, we'll be looking at valuations changes over a 2-day window. But again, see that the event study responses are insensitive over that 2-day period. Now, in face of that problem, we propose a general solution, which is to preserve the credibility of high frequency identification, but bridge that to the outcome that we're interested in with a model. We're going to follow one such approach for corporate investment with Q theory. What Q theory is going to enable us is to bridge the estimated clean effects of monetary policy on firm valuation to recover the response of corporate investment. I want to be very upfront that, of course, Q theory comes with many strong assumptions and caveats. So I'm gonna label this one approach, and we think this is a very first natural step, because on the one hand, it provides a very simple and transparent benchmark that should be contended with. And at the same time, as I'll show you in a couple of slides, Q theory seems to explain and describe the investments of US large public firms surprisingly well.
The assumption here is that the pre-trends that you're so worried about don't affect firm value? Is that what you're saying when you say that firm value that goes to investment? That must mean that you're implicitly assuming the pre-trends that you think screw up everything else don't screw up firm value or something.
There are going to be two very different exercises. There's one where I think the pre-trends are not contaminating. That's measuring the effect of monetary policy on firm valuation. Now, in the second exercise, under Q theory assumptions, empirically, it should not matter what's driving firm valuation, whether it is pre-trends in interest rates, a real surprise, or whether it is changes in growth expectations. That's gonna the mapping under our strict assumption is going to be invariant to what's driving the thing. So you should not really think about it as not a 2SLS method, because that would be, as you're correct, that would the identifying assumptions would be violated. Yeah.
I'm gonna follow up on what Neil said in a slightly different. It feels to me like we have to take a stand on what's happening on the pre-trends. For example, like one answer is people are learning about the world, and as John said, it's limited data, we don't learn enough, and so that's what explains the pre-trends. If that's the case, then the monetary policy surprise is about monetary policy and something we've learned about, some factor we've learned about.
Yeah.
It's not obvious that stock prices should load on the monetary policy surprise and the factor we learned about in the high frequency event in the same way, which I think you need if you want to interpret this in the way that we'd like to, which is the Fed leaks up and raises rates by 25 basis points, there's some action.
Yeah.
If that's intermingled in this high frequency window with something else we're learning about, which shows up as a factor that we learned about and shows up in stock prices in a different way, this feels like it muddies up your identification.
So I agree that we to get the full interpretation of the response, that I think has not been completely dealt with in the literature, irrespective of our exercise, we need to take a stronger stance. So now you should just interpret it in your favorite sense. I think there's a lot that is consistent with this that is learning argument. Yeah.
That matches the pre-trend, where you're learning about something, and then filter that through the high frequency data as well, and then maybe you'll be able to bring
that's a really great suggestion. That's precisely what one of the few things that we're working on, which is exactly that's going to help us with the interpretation of this headline number that I'm going to give you. So let me just very briefly sketch the framework. So we're going to assume Q theory in its most basic IHE form. So constant return to scale, perfect competition, quadratic adjustment cost. So the first order condition gives you that the investment is depreciation rate times vintage capital plus gamma I, that's going to be the inverse of the adjustment cost at the firm level, and then marginal Q minus 1 times capital. Now, under the assumptions above, marginal Q is equal to average Q, and then just working around the equation, you can appear in the parenthesis term the value, the market value of firm's productive assets, or otherwise enterprise value, minus capital. Now, under strict assumption, which is that the depreciation rate and the replacement cost of vintage capital does not respond to monetary policy, the response of investment to what we call the monetary policy shock is going to be the product and it's going to depend only on gamma I, so the investment Q sensitivity, and the response in value that we can actually directly observe with high frequency identification.
I think this equation is perhaps one of the responses to the earlier questions, because your model is essentially presuming linearity, right? And so it doesn't really matter. I think you're fine as long as the local average effect is small, but it's orthogonal, satisfies it doesn't matter what happened in the past. Given that it's, this is the right, if this is the right model, then you're all good.
Yeah, I need to think more about this, but I think the persistent. I think what's very important is for the interpretation is going to be the persistence of the interest rate change. But I need to think more about this. That's a good point. Now I just want to emphasize one nice feature of this framework is that by using high frequency identification to recover the change in enterprise value to monetary policy, we're recovering both the partial and general equilibrium effects of monetary policy. If you think monetary policy changes growth expectations, that's going to be capitalized in valuations. Now, just a bit more reshuffling before I move to implementation. What we want to study the response of is enterprise value, the market value of productive assets. Let me just define it as equity, the market value of equity debt minus net working capital, and further split that into bonds and bank loans. We're going to make two further assumptions. The first one is that the market value of bank loans is close to irresponsive to monetary policy. That's motivated by the fact that most bank loans are floating rate. Of course, that's not exactly right. Monetary policy changes the price of risk, and that will change the market value of loans, but we're going to have to abstract from that. The second assumption is going to be that net working capital in its value is very irresponsive to monetary policy. The idea is just that net working capital is very short duration. And so what we need to track under these two assumptions is the change in the market value of equity and outstanding bonds. Just quickly, the aggregation, the aggregate response of investment to monetary policy is the sum of the firm level response, which is the sum of gamma I times the change in enterprise value, which is the change in the value of stocks and bonds. And so you can just rewrite that as a weighted sum of the investment Q sensitivity times the market value sensitivity to monetary policy, which you're going to estimate at high frequency. That's just one scaling down by the value of aggregated W portfolio, so aggregated stocks and bonds, give you that the aggregated response is just it's just composed of two terms. The first one is the product of value weighted averages of investment Q sensitivity and value sensitivity to monetary policy. And the second term arises because of allowing for heterogeneity across firms, and it can give rise to, for example, amplification or dampening depending on whether firms whose value is more sensitive to monetary policy or the same firms whose investment is more co-moving with monetary policy.
Explain, I'm a little confused. What do you think about the time frequency for this discrete time model? Does it map to the daily data or is it time aggregated? And if so, how do you do the time aggregation?
Yeah, the way that we think about it, this is yearly data. And so what you're going to have to assume is that the high frequency response to the shock is going to be very persistent. Of course, it's untestable for the precise reasons that I highlighted before, which is that I cannot tell apart the pre-trend continuation from the effect of monetary policy on this firm value.
So the daily shock is persistent for a year.
It is persistent for the period over the year under which the firm is going to make investment decisions. But this is a strong assumption, and so far we've not found a way of reliably testing it.
Ultimate jumping. A lot of this is my fault because I'm responsible for eventually writing the model. I haven't done it yet. So let me take some blame for that. With that said, there is kind of two steps to the identification. We're going to show that Q theory actually works surprisingly well for predicting investment at the annual level. And so if you're actually sitting on the FOMC, really our takeaway is track Q. And once you track Q, that's going to tell you something about investment. We're then going to use the high frequency data to tell you how we think Q may respond to monetary policy surprises. Obviously, modulo to the pre-transitions we discussed, we don't know what a monetary policy surprise is. It's just something that happens to 1-year yields. I will hopefully, work on trying to formalize that in the model. But anyway, I just wanted to take some blame, for the lack of a model that was on there.
Yeah, so just before I give you the headline number, let me just tell you how we estimate what the framework tells us to estimate, which is these investment Q sensitivities and these return value sensitivities. We're gonna to trade off little estimation error with representability. We're gonna have a few inconsequential sample restrictions, giving us a sample of about 2,500 firm, and we're gonna estimate the value weighted average of these return sensitivities and investment Q sensitivity. In the interest of time, I'll just give you the headline number. The value weighted average return sensitivity to monetary policy is around 0.16. So 1 percentage point tightening lowers returns by about, lowers values by around 16%. Now, on the firm level investment Q sensitivities, we're going to be running investment rate regression on like Q, allowing for firm and industry time fixed effects. And we're going to do that for both capital expenditures, and expenditures into intangibles. That's going to give us a value weighted average investment Q sensitivity of around 1.7%. Now, I'll just keep the fact that investment works very well in the data and the negative covariance between sensitivities to give you the headline number, which is that a 1 percentage point monetary policy surprise reduces annual tangible corporate investment by about 33% for standard investment. Thank you very much. Yeah.
So the original Bernanke-Kuttner stuff was that a 1% monetary policy shock lowered stock prices by 5 percentage points. So you have 16 percentage points in firm value.
So you said 5%.
That seems
1 percentage point.
1 percentage point monetary policy shock lowered stock prices by 5 or 6 percentage points. That's the order of magnitude I have.
Yeah, so this I've been very fast. The sample that we look at is 2002 to 2023. We should think that, for example, the duration of the stock market may be,
It's not that. You're gonna get a number of maybe 4 or 5.
Okay, well, we have to look more. We have to look more into this. I don't have the.
But is that right? This is a 16% fall in firm value.
That's the 0.16 in unit return. So that's a 16% drop in 2 days. That's a 2-day return, which is twice as small. Sorry, the 1 day is twice as small. That's what I showed you in the earlier graph. That's a 2-day return. So that's not the one unfolding at high frequency. It takes about 2 days. Yeah.
Okay, well, let's thank Antoine. And we had a robust discussion, so I think I'm just going to move straight to the next paper. Emilienne is going to be presenting.
Oh, yes, sorry. Yeah. Yeah. Thank you. All right, so first, thank you to the organizers for this generous interpretation of what monetary economics is, and also apologies to the presenters. I had to miss the first few days of the session, but I was able to see many of your talks online. So this is joint with my colleague Mathieu. And so basically the paper is about understanding the transmission of capital demand shocks to the price and the quantity of capital in the economy. So the question is, to motivate, how does the economy absorb an increase in desired saving? Okay, so sort of 2 extreme cases would be an increase in the quantity of capital. We all wake up, we want to save more. Corporate sector just does a lot of capital formation. So that's what there is in, for instance, a neoclassical growth model. Now, the other extreme is that, in fact, the economy looks more like an endowment economy, and we decide, we want to save more, fine, then valuations will adjust to absorb this increase in saving. So the neoclassical growth model, which really forms the core of most dynamic macro model, has that consumption goods and investment goods are actually the same thing. So you can transfer them one for one, the relative price is constant, and therefore the capital stock absorbs the entire savings shock. Okay, now in the data, okay, it looks a lot like demand shocks in capital markets, they're absorbed by valuation. Okay, so for instance, if we look at the big savings glut of the 2000s, the narrative is that it did a lot to increase the valuation of US assets and lower interest rates, but not so much to increase real capital formation. Okay, so this paper, actually, we're going to argue that in fact, the economy is much closer to the inelastic case, okay, or in between if you want. And that's really due to two technological forces. So again, this is going to be only a real model. And so there's two things in the economy. There's technology asymmetry between the production and consumption and investment goods. And the second one, it's the differences in the occupation mix between the labor used in both consumption and investment. Okay, so we'll have a broad understanding of investment, accounting for intangibles. And the idea is that if you want to produce 1 unit of intellectual property products, R&D, okay, you're going to need different inputs than if you want to produce 1 unit of consumption, which has a lot of housing and education and so on. Okay, and so in particular, this difference between these two goods will be that part of capital demand shocks will be absorbed by the relative price of capital goods versus consumption. Okay, so in fact, that goes back to, Uzawa's work in the 60s. Okay, so let me show you the roadmap for today. So we'll start with a stylized model. So it's going to be just a 2-sector model with specialized labor. So think Uzawa 1961, if you know, with a Roy Frechette type framework for the allocation of labor to the different sectors, consumption good versus investment good. And so what we're going to do in this model, so the paper is really about medium, long run. So we're going to get formulas for the long run response of the relative price of capital, PK, and the quantity of capital in response to a permanent demand shock. Okay, so if we all wake up, we all want to save more. Really, more realistic case would be population changes, demographics, inequality. But if there's a sustained change in the desire for savings, it's going to have permanent change in the structure of the economy. And what we derive is formulas for the revaluation effect, so how much the relative price of capital changes PK and the quantity. Okay, but importantly, we're going to use this to really nail down what are the sufficient statistics that we need to answer this question quantitatively. Okay, so this is what's going to push us to focus on 2 sets of statistics, so factor shares across sectors. Okay, really a multi-factor approach that there's different types of capital, there's different types of labor. We really want to look at the inputs for these 2 sectors of the economy. And the labor supply elasticity. So how easy is it to take a worker that works as a construction worker and make them a software engineer? Okay, so we need an elasticity. We know it's not plus infinity, but 1, 5, that'll be the question. So then that moves us to the measurement. Okay, so how do we measure these numbers? So we're going to build on existing data, really the BEA make-use tables and the CPS for the labor side. Again, we'll talk a lot about this methodology. So what we find broadly in the data is that investment goods are much more labor intensive than consumption goods. Okay, so to produce 1 unit of investment good, you just need more labor and less capital than to produce 1 unit of consumption. And the second one is that these 2 sectors employ very different labor. Okay, so for instance, as I mentioned, the investment sector will have a lot of high-skilled engineers, managers, and so on. While the consumption sector will tend to have, different occupation, but also on average lower wages. So this was always true. Okay, so it's not about just the post-2000 with the rise of intangibles. You go back to the 1960s, it was still the case that the consumption good is less labor intensive. And at the time, it was a lot due to construction sector being very labor intensive. Okay, so it was always true, but the shift towards intangibles really accelerated this divergence between the inputs in these 2 sectors of the economy. And so that gets us to combining these sufficient statistics in a bigger model than the stylized one, including the many factors and the bells and whistles that we think matter. We do this calibration to the US modern economy. And so we find that if you were to compare the neoclassical growth model with our model, which is calibrated to the actual factor shares in the data, you'll find that over a planning horizon of about 10 years, okay, your demand shock has half the effect on the quantity of capital. Okay, so think about if you thought that taxes reduce investment, now you need to cut that by half compared to the neoclassical growth model. So this is quite large. Another way to see it is that prices absorb a third of the capital demand shock in the long run. Okay. Now that matters a lot. If you're into the public finance literature, this elasticity matters a lot. But let us give you one concrete example where we can see what this does, and it's to simulate a capital tax shock. Okay, and look at the incidence across workers, capitalists, and so on. And so in the baseline model, the incidence will shift towards capitalists. If you remember in the neoclassical growth model, it's really labor that pays for the capital income tax. Okay. Now, when capital is inelastic, existing capitalists at the time of the shock will bear more of the impact, precisely because the relative price of capital will embed the present value of these wages. Okay. So this is a paper. Okay, so this is the supply side, basically. So we have two sectors in the economy, consumption good and investment good. And so both are produced by Cobb Douglas, but notice different labor share. So alpha C being the capital share in the consumption sector, alpha I in the investment sector. Again, the difference between these Cobb Douglas coefficient, that's what we're going to call technology asymmetry. And as I hinted, we have a case that alpha C is greater than alpha I in the data. The second force is labor specialization. Okay, is again that there's one unit of effective labor if you want, but you need to allocate it to the two sector. And there's an elasticity phi that makes it the case that, sure, we can have more software engineers, but the marginal one is just worse than the average. So this is just another way to write a Roy model. Okay, so notice this is the neoclassical growth model. Once you plug in alpha C is equal alpha I, and then you take the elasticity to infinity. I didn't show you some of the equations, but you can figure them out. Okay, so basically Uzawa 1961. The theoretical blocks are just not new at all. So household problem. So this is going to be the demand side. So remember, the experiment here is that there's something that changes about demand, and we want to see what happens on the supply side of the economy. So these equations, you've seen them before. So you have a rep agent, CRRA, and so on. You consume, you purchase investment good, you get labor income, you get capital income. There's a capital tax rate. Look, this tau, it's isomorphic to other types of capital demand shock, but let's just put it here for today. There's the law of motion, and then you get the usual first order condition. So the dynamics here, the forward looking, is just the Euler equation. And then PK, the last one, is this valuation equation that just says that, the price of installed capital today, it's related to the income that it gives you in the future.
Why did you put the adjustment on the labor? Sector, you could put adjustment costs also on how you capital from one
Yes. So here I only put the ingredients that matter for the long run. So we're going to have capital adjustment costs and sector specific capital in the quantitative model. Okay, those are before, but even in the quantitative model, they die out in the long run. So the way we write adjustment costs, they wouldn't matter for the long run. I won't talk about it. We can talk it after. I could write this equation for K. Nothing prevents me to do that. I just don't know if it's the right way to think about it. But I'm open to this idea too. Okay, so equilibrium definition. So it's infinite horizon. So you choose the inputs. You have capital, labor, you allocate it. It depends on consumption, capital growth, and then the prices are such that people maximize and markets clear. Now, if you go back to Uzawa's 1961 paper, he pointed out this condition: capital share has to be higher in the consumption sector. Otherwise, basically, you get the demand curve is not even downward sloping. So anyway, so this is the maintained assumption, but any year in the data, every way we look at the data, this holds. So what does the model boil down? So for the styles model, I just want to focus on the long run, and let me give you the diagram. So the long run equilibrium in the capital market pins down a quantity on the x-axis and a relative price on the y-axis. And this blue demand curve is just what comes from household optimization. And it says that if there's a big capital stock, then the MPK is low, and I want to pay less per unit of capital. So the blue line is just usual stuff. The red line is the supply curve in the economy. So if you want the marginal cost schedule for the investment good, okay? And so what we get is that if you were to consider different possibilities of economy with different levels of capital stock, it would fit down a particular row. Okay, so this is just the general capital market equilibrium, okay? And in general, a demand shock would move us from A to B. We'll have a quantity effect, a price effect. Usual neoclassical logic is just that relative elasticity will pin down with margin goes up. Now, I told you this is the normal graph, but we insist on teaching that that's the normal graph, okay? We say that in the long run, the relative price of capital to consumption is constant for any level of capital. And so that's the neoclassical world model. And so now notice the same demand shock I showed earlier has a much bigger quantity effect and exactly no price effect. Okay, so behind this diagram, the idea is that we want to look at the moving from A to B, how much quantity change, how much price change. And so for the long run, we have the closed form formulas, okay? And let me just kind of read out loud the relative price response. And if you understand it, the quantity sort of follows through. But it says that in the long run, okay, if the demand for capital increases permanently, okay, the price effect will be positive generically, okay? And because of two forces, technology asymmetry, as I mentioned, different labor share in both sectors. And then the second term, labor specialization, the fact that the marginal worker I bring to the investment sector is worse than the average, okay? Now you can see the special cases. Second term, I take phi to infinity, it goes to 0. We get back to there's one type of labor. In the first term, I said alpha c is equal to alpha I, goes back to 0, okay? But generically, it'll be positive. And same thing for capital. Generically, it's going to be less than 1 over the labor share. That's another formula I like to teach, is that, permanent or just long run tax shock, they have a quantity effect of 1 over the labor share. Again, for exactly the same reason. Okay, there's these two forces that make the capital supply upwards.
This just a clarifying question. This labor supply elasticity it's the elasticity of moving between the two
Yes.
sectors, but isn't there some other parameter that's the aggregate labor?
The fresh, it's 0 now.
Oh, fresh.
Right, because here basically we work from a fixed unit of labor. That's the 1. Okay, you could add a fresh as well. Since we're doing a lot of medium long run, we keep the fresh to 0, but that could be added. But then again, what you see is that these formulas really you don't need to know too many things, right? The alphas and the lambdas are the factor shares, the sector specific factor shares, and the lambdas, I guess I just assumed you knew that notation, but lambda k is the capital share, lambda c is the share of the consumption sector.
But aggregate labor is fixed in the long run in response to one of these tax shocks.
Yeah.
So just on that point, so if you were to compare versus another neoclassical benchmark, which just didn't have the two sectors, then, in that case, you would get something which was an even smaller.
Sorry, I don't get it.
Okay. So I guess you're considering these two sectors and you can move between the sectors, maybe infinitely elastically, right? And then I guess there's another benchmark.
You want phi is equal to 0.
Where you have, some kind of aggregate labor supply elasticity, which isn't 0, but there aren't two sectors.
You're right, exactly. So that would be a third term. Maybe it belongs in the South model. So that would be the usual thing that, in addition, taxes lower labor supply in the long run.
Just to clarify, it's not the Marshallian, that it's the uncompensated long run elasticity that matters here.
Well, I haven't done it, so I believe you, but yeah. Sounds right.
You also have a prediction for the correlation between PK and the relative wage.
Yes, absolutely. Thank you. Thank you. Yes. So I was going to jump to measurement, but let me just do one thing. So in a sense, you could have said, well, you sort of cooked in some long run adjustment costs. I could have done that with one ad hoc function. There's more empirical content, precisely that this shock has a permanent structural change in the economy. The relative price of investment good worker will be higher, and so on. Yes, I'll come back to that once we do the quantitative model, but that's part of the empirical content.
You're free to have any short-term response you want, and that doesn't really make, I'm thinking that, I mean, there are these literature that looks at how changes in investment tax credits show up in the price of capital,
Yes.
which presumably tells you something about at least.
Yeah, I'll cite that literature. I'll compare the model versus data in the short run. I'm doing the long run now, but the paper is about the short run too. It's just that, this is actually the graph for the phase diagram too. Like unimpacted jumps here, and then the saddle is. Let me just do the long run for the analytics. Okay, so let's go to measurement. So basically, I don't want to spend a lot of time here, but I want to give you a sense of what we did. So we looked at factor shares and occupation structure for the consumption and investment sector, but we're going to break down the investment sector into 4 types of investment: equipment, structures, IPP, organizational fabric. BEA make use table, we do the consolidation, we capitalize organizational services. But the paper is updated online, it has all the citations. I guess there's no citations too much today. This TTS, wages and transition, would allow us to understand the extent to which workers can move across sector, and in the dynamic set up the transition path. So how long? Okay, so 2 graphs, and then we move to the quantitative model. The labor share gap between the consumption and investment sector. Let's just look at the dark black line for the moment, okay? X is the years. It's always positive. It's always the case that you need to pay more for labor costs to produce $1 of investment than $1 of consumption, okay? And then the other colored line tells you, if I was to just look at one investment sector versus consumption, and it looks at individually, also these sectors tend to be more labor intensive. And then there's a reallocation effect that we're moving towards more weight on the blue and green line as the economy becomes more intangible. Okay, so these trends are accelerating. So now we're about 15 percentage point decline. 15 percentage point difference between the labor share in these 2 sectors. Okay, so this is quite large. And the second one is an occupation dissimilarity index. I didn't give you the formula for the index, but it's between 0 and 1. 0 would mean that both sectors employ the same type of occupation. 1 is exactly different, no overlap. And you see, 40%, you'll see how much that buys in quantitatively, but it's definitely not 0, and for the same reason, it's been increasing over time. Okay, quantitative model. Okay, so now I want to put the ingredients to at least be able to do a short, medium, long run simulation. So 4 capital types, precisely because those have different inputs and their share have changed over time. So those 5 final uses, we can produce 4 different types of investment good or 1 consumption good, which is the aggregate. And then there'll be 3 education level and 66 occupation cells plus land as fixed factors. Okay, so we get sort of 4, n equals 4 is the number of capital goods, and F is equal to 200 is the number of factors. And then for the notation also, once we go to the general model, we want to distinguish between PI, which is the marginal cost of investment good, versus PK, which is the value of installed capital, okay? So first equation is another extension we do in the quantitative model. We add Q theory, okay? So we say, yes, in the short run, okay, the value of the installed capital and its marginal cost diverge, okay, but it's in the short run. What governs the time it takes for Q to go back to 1? It's driven by this theta, okay? Then the labor supply dynamics, now I'm giving you the linearized equation, but it's basically LF is the labor supply in one education group. Okay, we have college, no college, high school. And then LFO is the allocation of this labor within occupation groups. But no need to stare too much at the formula. Basically, there's 2 new parameters that govern how fast this transition go, and 2 new elasticities that govern what's the long run elasticity. Okay, so this is the most important slide. Because at the end of the day, it's a quantitative paper, and I want to show you kind of how we reach this conclusion. So the first set of parameters we need to put numbers on is the factor share. So those we're going to get them directly from the data. We're going to get the depreciation rates also from the BE. Then we have these parameters, eta and nu, which govern how does education choices respond over time in response to relative wages. And so those, we pick them from the literature. I put the citation, it's not super consequential, these two values. Let's leave it at that. What is very, very important and what took half of the time we spent on this paper is the parameters mu and phi, okay? And so these mu that are education specific, so there's 3 values, they tell you basically the speed at which the labor supply converges to its long run. Okay, so those we use realize occupation transition speeds from the CPS through the lens of the model to back out these phis. And then, sorry, to back out the mu's, and then the phi here, we do a big matrix. Okay, so it literally tells you if the relative price of this occupation increased by 1% while all the others are constant, what's the increased labor supply? And on that, we build on this paper. I guess the citation is missing, but there's a paper, Bohm, I think the group of German economists that they have a nice way to use realized transitions to back out these dynamic labor supplies. Okay, so finally, the adjustment cost. We've tried different things. Now we're building on this target of 1.5 for an adjustment cost, for a quadratic adjustment cost that we read through our non-quadratic formula through a mapping, but it gives us an adjustment cost parameter for each capital to match the semi-elasticity, the same semi-elasticity. Okay, so those are the numbers. And so for the rest of the paper, I want to simulate this permanent, unanticipated demand shock and look at the effect on prices and quantities. So here we have about 25 years horizon. In this case, we kind of reach the steady state. Let's start with the dashed line here, which is the new classical growth model. It just tells you, sure, you have a shock, the relative price of capital goods, it doesn't, okay? The general model has that on impact, it's about 1. So it's as if the price of capital fully absorbs the demand shock. But over time, it declines to about 0.3 in the long run. So in the long run, a third, if you want, of the capital demand shock is absorbed via prices. Now, for us, what was interesting is really what did we see in the data that made us reach this conclusion? Okay, so we decompose the forces by starting from the neoclassical growth model and adding the channels one by one. Okay, so if you start from neoclassical growth model and you just add the adjustment cost, okay, so that goes back to your question earlier. Yes, you do get some version of this, you know, on impact, and then over time you go back to Q is equal. Okay, so that's what you would get by having just adjustment cost. Now, what would you get by having just labor specialization? Now, that's a big deal, okay? In the short run, labor specialization is the big force, okay? And that's precisely because people are harder to move and the labor share is high. Whatever you produce in the economy, there's a big share of it that is people, okay? The last channel is this technology asymmetry. And you see it's interesting that it really doesn't matter in the long run, okay? But it builds up as you accumulate capital and you converge towards the long run allocation. Okay, so you see that in the short run, it's a lot about labor adjustment. In the long run, it's mostly about technology asymmetry. So in a present value sense, it's sort of half and half. Yep.
Sorry, I think I might have missed something. Does the model allow you to have complete elimination of labor specialization? You know, if there's like a persistent wage imbalance between the investment producers and the consumption producers, that you know, you get people flowing into the investment occupation or something like that. I mean, and it does. this simulation here seems like you're enforcing a long run limitation.
Yes.
on-
Yes, exactly. No,
Is there any reason? I think it's
Yeah.
realistic. It's perfectly plausible. I'm just wondering.
yeah, I mean, I can give you the answer to your question. The answer is that I did not pick plus infinity here. Okay, so this will pin down basically it's big matrix, but if I was to plug plus infinity everywhere, I would get that this labor adjustment is sort of a search friction. It's not about comparative advantage at all. Okay, so you see that now this yellow line sort of has both forces that in the short run, it's a lot about moving people around. In the long run is that, yeah, I can find another software engineer, but they're just not as good as the average one.
So you're gonna have like persistent wage differences across.
Yes,
that, yeah.
yes. Exactly, yeah. Okay, we can do the same thing for capital. Okay, so we start for the neoclassical growth model as the dashed line. Okay, and once we add all the model ingredients, we get the black line. Okay, so we can look at the long run, but if you just kind of look at a reasonable planning horizon and think that could potentially get to in the data, you know, it's half. Okay, so it's a very big difference on what the real effect of for instance, a tax cut would be. Okay, that's another part. I don't want to do it really, but this is a big part of the paper that we want to see, you know, what has to be true for these revaluation effects to be larger or smaller. So we did kind of a plethora of things. So I just want to point out maybe one that's important is that if we do not capitalize organizational capital, which the VA doesn't do, okay, we get that capital is less inelastic. Okay, so it's a big part of, for us, how we think of investment is combining goods, ideas, managers, and that's what gives the investment bundle. And once we do that, that matters a lot. We went with Tubb Douglas, but you know, if you change to different capital labor elasticity, that moves a lot the long run effects. Okay. And also we're in a closed economy, but we look, for instance, in equipment goods, they're very important. So what happens if you let them be imported with some trade elasticity? Okay, so that's in the paper. But then I wanted to spend time here, and that was going back to a question earlier. We wanted to say, what can we find in the literature as a benchmark against this? You know, I show you this, no one really complained, but in a sense, it's that how can we test that it's the black line versus the dash line? Okay, so we did some effort to look at the literature to find what the evidence was, okay, and try to convert these estimates into comparable measures. So here, the evidence really comes from equipment and structures. Okay, so the whole intangible side, I couldn't find much going on. And so this evidence mostly comes from the public finance literature to look at different shocks to bonus depreciation or investment tax credit and so on, and look at relative effect on prices and quantities. So there's, let me just go kind of briefly and tell you a sense what model versus data and how I think about the gap. So Goolsby had this paper in the QG, was finding a really big price effect. Okay, so that you had a tax cut, you know, something like after 2 years, about a third of the tax cut into higher equipment prices. I think the rest, I think that's like on the most inelastic side of the literature. Then there was more recent paper, House Shapiro and other House et al. Paper that they do different type of designs. And then they find that basically, let me explain what this measure is. Here's the share of price in a total expenditure change. Okay, so if prices were constant, we'd have these data, and the model would be all these zeros. If you look at House Shapiro and House, they find that actually the price share at a short horizon is very small. So it's like the equipment prices, it doesn't seem to move a lot. And I guess, and this is a question for you, but when I speak to public finance people, they tell me, yeah, we had 2 papers, they found 0. And so what are you doing with this relative price stuff? So I kind of gave some thoughts on that. I don't know how much I want to say, but there's one thing about measuring prices, okay, that of course you have this aggregate index, whether it moves or it doesn't move, measurement errors that could be at play. The other one is the model really is about fixed markup, fixed TFP, okay? And if you look at the House et al. Evidence, it doesn't look like that at all, because it's like prices don't move, but then, you know, you employ a bunch more people and you pay them much higher wages. Because these two are only can be made consistent with markup declining. So okay, it seems that over a 2-year horizon, you sell equipment good, you absorb through your margins. That's something that's in the model. But I'd like to hear your thoughts on this. Yep.
Are these the shocks that you would actually want, given your model, which are like aggregate shocks? Because it was.
No, I mean,
So then they are not relevant for you, right?
no, but let me tell you, you're exactly right. The reason why there's 3 paper here and not 500 is because I cannot have a regression with time fixed effect. That doesn't work. You're capturing all GE relative prices. So those don't have time fixed effect, but they have these designs usually that they look at different exposure across type, but still in an aggregate kind of regression framework. So I only chose those because they don't violate my restriction of no year fixed effect, but it's not the ideal experiment to answer this question.
Related with separate question, there's also other literature about sort of this separation between investment and Q,
Yes.
right? And can you?
Yes, let me clarify. Yeah, so for us, it's so the only Q will come from this equation. So here, PK is not Q, right? So PK is capital in terms of consumption, while Q is installed capital in terms of uninstalled capital. So here we have Q here. So if I was to use the model to simulate the missing investment, part of it would be absorbed by the Q, okay, but part of it will be absorbed by the PK. And so so we have both the Q and the relative price in the model. And so yes, I can do that. I can engage with the Q literature and say there's another part that you don't measure the relative price. It's here. I think the Q we don't have much new to say. We kind of.
Right.
Yes.
Perhaps I'm misunderstanding, but is there a complication that in the data, in the real world, a lot of investment equipment is imported? So
yes.
I'm building a data center.
Yes.
Chips from Taiwan.
Yes.
The model is all about.
Yeah, so I do. Good question. So I did. That's what I thought. I said, aha, because you just need to put export. Turns out the way I do it, it doesn't move the needle that much quantitatively, but yes. And in fact, this paper de-emphasized the role of imports. Because basically the US is a closed economy except for equipment. It's a large share that's in this. So that's a good point. Turns out the way I modeled it, it didn't do much. Okay, let me just finish with this tax experiment. So basically, okay, so let's say now we take the economy, we simulate a permanent capital income tax change, and we see who bears the incidence. Okay, so it's a full present value because it's welfare effect. And so there's too many numbers. Let's just look at the numbers in red. But basically, we can see in the neoclassical growth model, capitalists bear a quarter of the incidence, and then in our calibrated model, it's a third. Okay, so there's a 10 percentage point shift of the incidence away from labor towards capitalists. This is present value. Yes, because it's welfare. Yep. Yep. Then, so this was around the undistorted steady state, but you might say, well, the economy is distorted. So let's start with there's a 20% capital income tax rate. Now you still have that redistribution, but really what happened is that now you can ask the question, if I was to remove all taxes, okay, exactly. When the economy is distorted, if the government spends $1 on tax cut, there's 28 cents of aggregate welfare increase. Okay, but that's lower than the neoclassical growth model, which is kind of crazy. You start from tau is equal to 20%, and cutting $1 of taxes increases total welfare by 50%. Okay, so there's less cost, there's less distortion to taxing, and there's also less benefit from removing taxes. Of course, this is a transition. If you just look at the long run, it's a different question. Okay, and let me finish by these things. So you can say, okay, I live in this economy, which occupation will benefit from a capital income tax cut? And that goes back to the question of, this model has much more prediction than just quantities and prices in the capital market. And here is like the elasticity of a permanent tax cut. So executive and managers, engineering, computing, they have big wage increases. And then nurses, health, and I guess us, we have a much lower kind of beta if you wanted that action. Okay. Now you can ask the same question for capital types, and then you get sort of an investment advice of sorts, which type of capital would benefit the most from a tax cut? Is it land, structures, equipment, IPP, organizational capital? And it turns out land and structures, okay, the present value of their cash flows increase much more than these intangible type of capital. Okay, why? It's a lot about the depreciation rate. Okay, so if you invest, hiring a managing team, can think it creates more capital that lasts for 3 years, 5 years, but land is, lasts forever. And doesn't have to, you don't need to reinvest them. Okay, so then you have this sort of also pecking order of what would you want to tax first. This is very elastic, you want to tax it, and this is. Okay, so let me finish with this graph, which is a way to think about the Harburger triangle in this economy. Okay, so here I'm plotting the marginal effect of a tax cut for an initial level of taxes. Okay, and so this is the calibrated model, and so the area under this curve, okay, is like the total welfare effect. And if there's a square, you want to have square, we've done this not before, but it's the present value of the capital stock change. Okay? And so it would have been a bigger triangle in the neoclassical growth model. You lose more. But what's interesting is that the way it comes up, it's exactly the same, right? Having an elastic capital, so K doesn't change a lot in response to dementia, is the same as having a small hardware triangle. That's kind of the known connection from capital supply elasticity to public finance. But in this dynamic setup, it shows up nice. So I'm out of time.
So we have a few minutes for questions.
Can you go back to your labor split equation? You split one into the labor equation, labor supply.
The first one.
The first one, yeah, the very first one. My comment regards that. So I think you should emphasize much more the final part of the paper where you connect with relative wages. The reason is that if you look at that equation, I can do a change of variables where LC to that power, I call it a new labor. And LI, I call it a new labor. And it becomes a linear equation, just I take the other coefficient to the other side. So what I'm trying to say is that this model with the long run moments that you gave us is isomorphic to a model which is a linear split. But the adjustment cost here plays a super important role.
Yeah.
What allows you to identify that is like the response of relative wages that only come at the final part of the presentation.
Yeah. No, that's a good point. It's this fundamental thing here that factor prices respond, even in the
factor prices, the model is isomorphic. I mean, I'm sure when you show the impulse responses, I can find a new reconfiguration of parameters that put the yellow on top of the black.
No, that's a good point. In the paper, we emphasize a bit more, but well taken.
Okay, well, let's take a break and reconvene at 3 p.m. Okay, let's get things going again. Angus, you can present the paper of the day. Go ahead. Okay, so thank you very much to the organizers for including this paper. This is joint with Joe, Asif, and Belinda, who are sitting in the second row there and ready to answer questions. And Belinda and I are from the Bank of England, so we have the usual disclaimer here. So we're going after a very sort of classic question, and that question is, how do interest rate cuts affect consumption? And we're going to be focusing this on the lens of households who have debt, and for them, a change in rates can affect the debt service on existing debt payments, and then also give them the chance to and perhaps encourage borrowing, and that can then feed through to consumption. Now, recently in this macro literature, there's been a lot of focus on other mechanisms through which rates can affect consumption, particularly the Hank literature, looking at rate cuts affecting consumption via higher income in GE. And so what we're going to be doing in this paper is using natural experiments for the UK mortgage market, and then merged household level consumption mortgage microdata to try and isolate what we're calling this household debt channel. And this is this debt channel, which has this direct effect on households, abstracting from the GE component emphasized by Hank. So that's what we're going after. Focusing on UK mortgagers, a couple of reasons. One, as we'll see, this gives us a nice setting for identification. Two, also, they account for about 40% of consumption in the UK and a very large share of household debt. Overall, in terms of where we're going to find a large role for asset prices. And the idea we have there is the classic idea that a cut in rates can affect house prices, which then affects loan to value ratios, borrowing capacity, and then consumption. So that's going to be a kind of a big part of the mechanism we're going to be finding today. So going back to this natural experiment, this is something which James Cloyne and co-authors have used in a couple of papers, the first to use this. In the UK mortgage market, unlike the US, households are choosing fixed rate deals, which typically last 2, 3, or 5 years. The mortgage still lasts for like 25 years, but they have this fixed interest rate component for a short period of time. And I'll go into more details later, but there's going to be very strong financial incentives for households to refinance exactly when the deal expires. Penalties before and large costs afterwards. And so that gives us a predetermined time at which households tend to engage in the mortgage market. And I should say up front as well, the UK market doesn't have a second charge market, so the chance to borrow is really through your mortgage and just through your main mortgage. So the adjustment occurs at infrequent times. Then in terms of data, we're going to have an innovation here and be able to link the administrative mortgage data with high frequency consumption data at the household level. So we're going to have microdata on mortgages and consumption for a 10-year period. And then we're going to be exploiting natural experiments. So our idea here to estimate this household debt channel conceptually is to compare two households whose deals expire at the same time, but these expiring deals have different length. And because of different length, these households are experiencing different changes in interest rates at the same point in time. So through that, you can difference out the sort of common components of income at the time of the deal expiration and anything else happening in the macroeconomy. And what you're then left with is this household debt channel. So conceptually, you have different rate cuts, but the same income and all other contemporaneous shocks for these households. That's really the first part of the paper, explaining how we do this. And the second part is then measuring the importance of asset prices for the household debt channel. We're going to find that borrowing responds a lot, and this seems to drive a lot of the consumption response. The question is why. We're going to be trying to be sure this is actually coming through house prices. And we're going to use two different sources of variation here to get at this, following a lot of existing literature. First of all, looking across regions and looking at regions where house prices respond more or less to rates. And then more novelly, within regions exploiting in the UK that you have variation in the housing duration.
And in terms of results, we're going to find this household debt channel is powerful. So first of all, after 12 months, after a 1 percentage point cut in the aggregate mortgage rate, cash on hand, which we defined as this change in borrowing less the change in debt service. You can think of that as the change in financial resources. That's going to rise by about £2,000. Consumption is going to rise by about £1,500. That's about 5% of annual consumption after 1 year. If you combine these two numbers, you're getting an MPC out of this cash on hand of 0.7. This is not an MPC out of a transitory income shock. This is an MPC out of this permanent or semi-permanent change in your new mortgage contract. So you're taking on a new rate for 2, 3, or 5 years. You know exactly what your payment's going to be, and then you respond a lot to this change in resources. Also, we're going to be finding here, cash on hand is two components. We're going to find that borrowing is actually responding more than debt service, which is interesting in itself, in contrast to a lot of recent literature. And then that motivates the question of why is borrowing responding? We then look at the response of asset prices driving this and looking at how rates move house prices and home values and how that then ultimately affects borrowing consumption. And we estimate that a £1 instrumented increase in home value due to a change in rates is going to increase borrowing and consumption by around 4 pence. So 4 pence on the pound, which is quite comparable to some other findings for the response to house prices in different settings, where it's not just coming through rates. So that's the plan. In terms of literature, we tie to a few things. First of all, certainly a couple of James's papers on the UK mortgage market and borrowing and exploiting this nature of the UK mortgage market with natural experiments. In contrast to that, we are really looking, first of all, at consumption, but also rather than one of his papers looks at the impact of house prices on borrowing, we're really looking at the impact of rate-driven house prices, both on borrowing and then linking to consumption. Then there's been more recent literature looking with microdata, linking interest rates and consumption. And perhaps the most famous here, most relevant for us, is DiMaggio's paper in the AER in 2017 using the similar sort of microdata. That paper and a lot of literature focus on cash flow effects. Some of that is because of the setting they're looking at. In the setting we're looking at in the UK, borrowing can go up or down at the time you get this chance to refinance. And so we also then look at borrowing, and we're going to be finding that borrowing is driven by asset prices. So we have both cash flow effects and also borrowing effects, but we actually find these borrowing effects are more material. And that's really kind of a big emphasis of this paper. The other thing is this contribution on the data side and to actually have a measure of consumption, which we can split into durable and non-durable consumption and measure this at monthly frequency at the household level. Obviously, then we link into a broader literature linking monetary policy and consumption using aggregate data. We provide this new methodology of picking out one particular channel of this quite precisely, but only one part of that. So that's the plan we have. So I'll say more about the mortgage data, first of all. The mortgage data comes from the UK Financial Conduct Authority. What we're using here is data on the universe of outstanding mortgages. We get this at the Bank of England every 6 months. We have this over a 10-year period. And with this, you can track the same households over time. And importantly here, you can see what happens to the household, whether they refinance or not. So you can see that, and you can see all those other variables you wish to see as well. The more novel part then is to then bring in some consumption microdata and actually link it to this mortgage data. First of all here, we use this data from Money Dashboard and ClearScore. These are personal finance apps. ClearScore ultimately bought Money Dashboard. But the way these work is that individuals can choose to sign up for these apps. And in doing so, they end up sharing their data. And in the UK, we have open banking. And so through open banking, when you share your data just once, it takes several years of historical data. And so you should think of this in the American context to be like sharing your data on your checking account, for example, and your credit card. And what we then see, and we have this for about 1.7 million individuals, is transaction level data. So every transaction you see in your bank statement, we see as well. So the date of the payment, whether it's a credit or debit, the amount paid for it, and also crucially a transaction description, which can then be used to infer where it was spent, what type of expenditure was this. So we do this, and then we also then use BEA rules to kind of aggregate these individual transactions up to measures of durable and non-durable consumption. Now, of course, the sort of elephant in the room here is this is a selected sample by construction. So we do a number of things in the paper to try and reassure ourselves around external validity. First of all, we look at the overall expenditure to see, is that capturing most of the household's expenditure? We compare it to official surveys from the UK, and the overall quantities are very similar. And secondly, we can exploit a nice feature that because we can actually merge these two data sets together, we can compare two populations. So from the mortgage data, we have the universe of mortgagers in the UK, and then we have this subsample of merged mortgage and consumption data, and we can compare how the two of them look to each other. The sample data of the consumption is slightly different. It's not hugely different. As you might expect, the people that are slightly younger, slightly higher LTV. What we can then use is the full mortgage sample to then construct sample selection weights and use this to reweight our samples. And after we've done that, they look very similar on these characteristics. Another thing we can do as well is because we observe mortgage outcomes for both samples, we can then look at the mortgage outcomes in both samples separately, and we see very similar results there. So overall, we think we're not too worried about external validity here. We can learn something more broadly about consumption for UK mortgagers. And yes, we can convert both of these to monthly frequency. So we can see at sort of very timely frequency how consumption and borrowing responds around these deal expirations. So going back to these mortgage deals, so again, UK mortgages have amortization period of say 25 or 30 years, just like in the US, but you don't get 30-year fixed rate mortgages. These products typically do not exist. Rather, the structure is that people take on various short-term fixed rate mortgage deals, typically 2, 3, or 5 years. And over the period of our study, really for the last 15 years, this is about 95% of the UK mortgage market on originations looks like this. So this is not like some subsample that's special. This is really just the whole mortgage market. And what you'll find is people will pay a rate, and for that fee, maybe at £1,000 to £2,000, you then get a lower mortgage rate. It's called a teaser rate, and that rate is fixed for this period, and that's quite a lot lower than the prevailing rate you get on the market otherwise. So you pay a fee, you get a lower rate, and you get some insurance against rises in rates over this period. And the rate you're then paying is going to be determined by conditions when you take your mortgage out. So why is this a natural experiment? Well, first of all, during the deal, there's going to be strong incentives not to refinance early. The bank has this guaranteed interest income. It wants to preserve it. And so if you want to then remortgage or pay off your loan, there's going to be an early repayment charge. And that could be around 3% of principal or higher. Yes?
Do you pay that repayment charge? Pay off the mortgage?
So if you pay it off, you pay the repayment charge. A separate question is about portability of mortgages. So in the UK, probably about 2/3 of mortgages are portable. So you can actually take the mortgage with you. And so you wouldn't necessarily have to pay it. Yes. That's one difference to the US. But in general, if you pay it off in any means, yes, you have to pay this repayment charge. And this is very high. I think it's kind of almost comparable to some deposits. So people don't want to pay it if they don't have to. So they tend to wait. The flip side of this is when the deal expires, there's going to be a strong incentive to start a new deal because the banks like having these deals, and then you roll on to what's called the standard variable rate, which is about 200 to 300 basis points higher. So you get this sudden jump in rates if you do not refinance, and the banks then encourage you to refinance. You can then pay £1,000 again and get onto the new lower rate deal. The banks like, I think, that fee income. And this is not a surprise, it's anticipated. You know the date this is going to happen. The bank will remind you. If you had a broker, they'll remind you as well. And some banks give this chance to actually refinance up to 3 months early and lock in a new deal. Also, while it's anticipated, if you forget, you'll soon know, because as soon as you pass that next month, your mortgage payments will go way up. They might double, for example. So you have a very strong incentive to actually act on this. And the key thing here as well, again, perhaps in contrast to the US, there really is not a very big market in the UK for second charge mortgages. So in that period of your deal, it's very hard to extract home equity, except through waiting for this deal to expire. But when the deal does expire, you can scale up or scale down the mortgage without penalty. So you can then use this chance to pay back your mortgage if you had a windfall, or take out more borrowing if you have greater resources. So what we then have overall, because of this strict structure of this, is going to be this change in interest rates, and also this refinancing opportunity at this predetermined time. It's going to be staggered across households because it's all relative to them and when they took their mortgage out to start with. And also then it's going to be anticipated for the household as well. They know it's coming. And that's the setting we have here. And in terms of samples, in the full mortgage sample, we have about 7 million of these natural experiments, 7 million of these deal expirations. For the mortgage consumption combined sample, it's about 70,000. Question.
Say something about why somebody takes 2, 3, or 5 years when they do refinance.
Yes, so we're not maybe looking into that. There's a literature looking into that. we're going to come to that question. It becomes relevant for us in thinking about what you chose in the past and what characteristics that may be for you. But ultimately, the main source of variation we prefer is comparing people within the same deal length. So what I can perhaps, I actually maybe don't have it here, but people, for example, in a 2-year deal, they don't all take out exactly a 24-month mortgage. There's just distribution around that from about 21 to about 27 months. And so you can actually compare somebody, and you and I are maybe the same, we take out a 2-year mortgage, yours was 22 months, mine was 26 months. And because of that, there's some variation in the rate we experienced at the start of our deal. I'll come back to that point, but yes, it's a good question about what you select into. But from our point of view, we're really more interested in what you chose in the past rather than what you're choosing at this point in time.
But you know, the 3 versus 5 versus 2 affects what your delta and the capacity is going to be because the rates aren't flat.
Yes, so the way we're going to look at this is, because that's an endogenous choice, we don't want to look at the endogenous choice of the interest rate you then face. The way we're looking at this is, on our right-hand side, we'll have the aggregate mortgage rate, which is the mortgage rate on all new mortgages, and we look at the change in that variable for you. So what it was at the start of your deal relative to what it is now. So then that's unrelated to you. And then separately in the paper, we also look at using that as an instrument for the individual change in rates, and it's very similar. Any other questions at this point? No. Okay, so in mortgage, yeah, so the sample is 7 million for the full data, about 70,000 for this consumption sample. And linked to sort of prior question, we are going to be restricting to households who don't move around deal expiry. We have looked at this, there's not that much action in this period, it seems, probably because of the portability in general. Okay, so I'm trying to convince you it's a natural experiment. I think a picture might work better here. And this is looking at a simple event study, completely unconditional, looking at this around the end of your deal. So what we're looking at here in the y-axis is just a 1-0 dummy for whether you refinance the month in question. Month 0 for those in green are those whose deals expire exactly in that month. About 50% of them are refinancing exactly then. Cumulatively over this window, about 90% of them are refinancing. It doesn't matter for us that not all of them refinance. Some of them can have rational reasons for not doing this. They might want to, they might expecting a windfall shortly afterwards, or want to change their mortgage payment soon afterwards. Or if they have a very low mortgage balance, maybe looking to pay it off. But the main point is here, there's a lot of action. And then in red, by contrast, we have a group of control households, and they're the ones whose deal started at the same time, but it's a longer deal. So their deal is not expiring in this window. And this is the people who'd be facing a big financial penalty were they to refinance. And we can see that essentially there's no action here. So what this picture conveys is if your deal is not expired, you do not respond with borrowing at all. When your deal does expire, you respond.
Your Neil's question, but you said there was this, you're within this like 2-year choice, but you were saying there was some variation in that, but that was like less than 6 months. So I would have thought the red line would have start to move.
Oh, you're right. I'm jumping around a bit. So this is not our identification strategy. This is just an illustration. So this is comparing all people whose deals are expiring at this point, and then everybody with a mortgage longer than their mortgage. And then when we come to sources of variation, well then we can, our baseline is comparing people with different lengths of mortgage, but then we have versions, as to Neil's point, where we look within, say, a 2-year deal. And yes, you're completely right there. We can't do 2 people in a 2-year deal whose mortgages start at the same time but don't expire at the same time. That wouldn't work in this window. You're completely right. This is just for illustration to show the action is concentrated in these periods. Yeah.
Financing sometimes 1 or 2 months before they pay this 3%, they don't want to wait a month.
No, they don't. So like some lenders let you do that early. So some lenders say up to 3 months early, you can lock in a new deal and move. Absolutely. And then some are going afterwards, and that might be because they got this, they missed it, and then they suddenly realized, and then they refinance at that point. Yeah.
If I sum these up, it looks like they summed to less than 1. So there's some people who are kind of asleep or inattentive who don't refinance and they get ripped off by the banks.
Yeah, so that you're right. There's about 90% who are refinancing and 10% who don't. And so those who don't, they could be inattentive. Can also be quite rational because if your mortgage balance is very low, you still pay the same fixed fee. The fee's still £1,000. The saving may not be worth it if your mortgage is 20,000. Also depends what you think is going to happen in future. People might like the flexibility, for example. If you think you might get a windfall in 6 months' time, you might then wait and just not do that. So yeah, there's various rational and non-rational reasons for not refinancing. It doesn't actually matter for our identification strategy. We're looking just what's happening overall to your behavior after this event. But
There are ways to use some of those households who don't refinance to see what happens to consumption, because they're clobbered with this huge interest rate increase that's. They have a choice in some sense. Well, additional or not refinancing, they have a choice, it just goes up, so you see their consumption go down.
Yes, I mean, like we had an idea. I mean, I don't know if this is exactly your question, but one thing you could try and think of is trying to look at people, trying to sort of isolate this cash flow effect, saying that the borrowing's not changed, but then we tried to look at a version of this. So the UK does have a small sample of mortgages, which you pay a fixed rate, but you have a floating rate. You pay a fixed fee, but you have a floating rate, but it's lower than the market rate. And those households still have early repayment charges, but then they're disincentivized from borrowing early, but they see a change in payments. The problem with this is, though, that it's quite a small sample. Also, like during the period of interest, when rates start to go up, they all default, they all jump out of it because it becomes too punitive. Rates go up too high and then they just fix. So we did try that experiment, but it didn't really work in the UK context. But yeah, good idea. Okay, so okay, so now that was unconditional. That tells you nothing about the household debt channel, just that we have a natural experiment. Something happens at this time. And then to try and get into this question of how this relates to interest rates, we then have a sort of simple framework in the paper, building on work by Peter and others. So it's a sort of standard model with mortgages, and then we add in collateral, so classic collateral for household borrowing. And the aims here are very simple. It's just to try and define this household debt channel and then show the importance of borrowing and asset prices. And the key really is just to actually use this to show how we actually map the model and those quantities into our natural experiment. So the household has a problem here. They had an old mortgage deal that was expiring. They're going to then choose a new mortgage deal at time zero. We're assuming they're not moving. They're maximizing discounted stream of consumption over the length of the new mortgage. And there are two assets here. There's a mortgage D, which is going to amortize that fixed rate outside of this window. And there's going to be a liquid asset here, A as well, which is some lower bound on it. This is the household's problem, and there's going to be a shock to interest rates. And to bring in the collateral side of things, we're going to have that the rate here that you pay depends on some sort of base rate in society, plus a spread, and the spread depends on the loan to value ratio. And this is very realistic for the UK. The UK, as James's work and others have shown, the payment that you face on your individual rate is really just a function of the loan to value ratio. There's nothing individually priced otherwise. And so this is realistic. It's more a step function going up, but essentially it's some sort of convex upward sloping function. You can also then nest a hard LTV constraint if this goes vertical. So this is all we need really to define this household debt channel. We show in the paper in this setting, the change in consumption can be split into two terms. First of all, the term we care about, household debt channel, and then secondly, terms in the change in income and the change in returns and liquid assets. So the household debt channel, again, to define this is the change in cash on hand, which is the change in borrowing, less the change in debt service. So you have this change of being able to borrow more if rates go down, and also then you have lower payments on your existing debt. That gives you more resources. Some fraction of that, this MPC, you're going to consume, and that's what your consumption changes by. So the household debt channel is this direct effect of these rates on borrowing and payments, and then what fraction of that you consume. Again, to emphasize, this is not the MPC out of a transitory income shock. This is the MPC or this change on cash on hand, where rates are going to be then fixed for 2, 3, or 5 years. So quite a persistent object. So we're looking at that. You can then characterize more the Hank literature, looking at these other terms and how is income responding, and that can be due to monetary policy, other factors at the time of your deal expiring, and also this change in rates and liquid assets. So looking at the borrowing side, which the previous literature didn't focus on so much, a few terms can drive that. One is intertemporal substitution, one is wealth effects, and then also one part we're going to be focusing on here particularly is response of house prices to rates. So again, if rates go down, house prices go up, my loan to value ratio comes down, I can then borrow more, I may borrow against this and use that to fund consumption. So a very sort of classic collateral story here.
Disentangle the fact that when they get the ability to refinance, the house price will vary for other reasons across households. So at that moment, households experience both a house price shock and a new choice in interest rate.
Oh yeah, so we're going to come to that. We're going to be looking, I mean, essentially there's two things we're going to be doing. First of all, looking across regions where there's cross-sectional variation in how much house prices respond to rates. And then secondly, within regions as well, comparing households by their duration. So we're going to be able to generate variation in house price changes for a common interest rate shock. And the idea again here, largely, is that the interest rate is kind of common across the whole UK. I mean, subject to the individual variation due to LTV constraints, but it's not priced otherwise separately. But we'll come on to that properly. Yeah. Neil?
Still worried a little bit about the fact that if you know you want to have money to buy something, the elasticity you're gonna get out of this may not be the one that we would typically see. So for, you know, your kid needs braces or something, so you borrow a little bit more by taking the interest rate that gives you the most capacity. So don't we have to worry about whether or not this MPC is not, I guess it's probably biased up,
I think the key point. I think the key point again here is this is not an MPC out of a transfer income shock. This is an MPC out of cash on hand. And I completely agree with you. The borrowing choice is endogenous to what you're going to be consuming. So I mean, I think this is the thing. We're going to see a high MPC here, but the borrowing response is exogenous in the sense of you've seen a change in rates and then you adjust your borrowing and consumption plans. But the key point is I'm probably not borrowing randomly. I'm borrowing with a consumption path in mind, like you're saying. And so then I'm typically going to consume what I borrow. And we didn't see that.
question is this elasticity? Yes. It tells me that the people that need braces borrow more to be able to afford the braces. Is that, you mind that? Is that okay? That's the way I want to put this side.
So this is also different ways of decomposing the total effect that we are estimating. The key is the total effect. The total effect is the how much you spend and borrow for a 1 percentage point interest rate. That is the total effect, and then you can decompose it in different ways, which is what this equation is showing.
Emmy?
Sort of a similar question. So if the households were on their consumption Euler equation, then wouldn't the simplest case be that the MPC is 1, and then just, you know, they borrow because of whatever, you know, to response to interest rate changes? I was trying to think about why MPC would be less than. Is that because you borrow and then you save in a different mechanism?
Yeah, so the model has liquid asset as well. So we have liquid assets. I mean, we had this in the model before. We just have one asset, you get an MPC of 1. Yes, I mean, I think also it's a question of horizon because you probably borrow with something in mind. When you actually consume that may be out with the horizon we're looking at. So you could borrow now, you may do home renovations in a year's time, and so then you'll save it in the meantime. That's could be another reason as well. Okay. Okay, so what we're going to be doing first of all is then thinking about how to map this to a regression equation. And later I'm going to come back to this question that James had about how we then think about asset prices and how this works in the variation there. So this is the equation we had again. The change in consumption is this household debt channel plus essentially GE stuff. What we're then going to do is then throw in a time fixed effect. So again, the idea here is looking at 2 people whose deals expire at the same time, absorb all that common time series variation at that point in time, picking up common movements in income, returns on assets, etc. And then everything idiosyncratic goes into the fixed into the error term. And so identification assumption then in particular is the interest rate change you faced of your deal is going to have to be orthogonal to future idiosyncratic income, which may be affecting how you respond. And again, the idea here is this natural experiment is trying to difference out these GE movements in income and other terms, leaving me with the object of interest, which is this household debt channel. And to make the comparison here, which the question will probably come, you couldn't run this regression and get an unbiased estimate in the US, where you have more of an endogenous choice about refinancing. Whereas in the UK, it's based on some choice you made 2, 3, or 5 years ago.
So how should I think about the definition of delta interest rate?
Delta interest rate here is going to be the change in the aggregate rate between when my deal started and when my deal expires. So it's completely unrelated to my endogenous choices. The N subscript I there is for the length of the deal the individual I had.
But my actual windfall depends on my actually chosen interest rate or aggregate interest rate.
If I regress one on the other, the coefficient is almost 1. It's very close to 1. So you can do that as a separate way. If you use the individual rate and the instrument with the change in the aggregate rate, you get very similar answers.
Well, I guess what I'm worrying about is like house prices moving around and then moving around the LTV distribution and then endogenous choices on interest rates, it's correlates with asset prices. And how to kind of think of all of this, because there's a component which is idiosyncratic, which must affect the MPC estimate.
I mean, on average, it doesn't, I'd say, I think, because this coefficient is 1. I mean, something separate, which is not quite your question, but I should mention, is that The individual rates can move around as well because of asset prices. So, and we do see that effect as well. So the areas where prices move more, you see a bigger change in individual rates as well. Adam.
So the time fixed effect is gonna absorb some of the response of house prices to interest rates.
Yes, the common components. Yeah.
About like, you have this channel, which is the asset channel.
Yeah.
But some of that is gonna be absorbed in the fixed effect.
Yeah.
So how do we know, like, what is the characteristics of the residual component? What's driving it, and how can we figure out the magnitude of that asset price channel if some of it's in fixed?
Well, so I'm going to be exploiting the cross-sectional variation to pull this apart. So conceptually, I'm going to be looking across different regions, and different regions have different sensitivities, and then using variation there. So you and I could both, maybe we're both in the same area, our deals expire at the same time, we'd slightly different changes in rates. That results in slightly different changes in house prices for us. And then off that, we can then identify the impact of these house prices on borrowing.
Some sort of really strong assumption, like, that variation would go away if I had a time by region fixing.
No, it goes,
Right?
no, because that's all about what's happening at the deal expiration. So you can take out common things that are happening, deal expiration time. What it goes away if you have start month times finish month times region fixed effects. So you absorb any particular local trends. And we have an answer for that. And we can do that. And then we have this variation in housing duration within region, which then allows me to take out all local trends and still have some variation. I'll try and get to that. I think I'm running a bit slow here, but look, if I can postpone that, it'd be useful. We're going to be looking at these sort of local projection responses to these changes, conditional on different fixed effects. And I think I should just get to it. To talk about variation, we have cross-sectional variation at a point in time. This is very nice. We can estimate our channel at a point in time. What is this showing you, for example, in 2019 is here's the change in the aggregate rate for those whose deals expire at that point in time. And all that variation comes from when their deal started. So somebody's deal started 2 years ago, somebody 5 years ago, that results in a 1 percentage point difference in the rate they're facing at a point in time. So you can use that cross-sectional variation to try and identify the impact of rates on borrowing consumption. That's kind of the key idea of what we're doing.
Individuals do have a.
This is aggregate. This is aggregate. So this is like saying you and I both have a deal expiring today. You took out your deal 5 years ago. I'm 2 years ago. We have different change in aggregate rates over our time period.
Right, aggregate, the individual experiences different changes in aggregate rates because of the duration.
Exactly, that's the point.
That's what the cross section.
Exactly.
You worry that there are other aspects of the mortgage. So my rate is a very high rate. I can extend my mortgage over a longer life to make the actual change in cash paid is much lower.
Yeah.
Or if it was favorable, I could shorten it. That's not okay, that's not yeah.
These are all outcomes. They do increase term, for example, in response to an increase in rates. It's not a huge effect, but yeah, I mean, our setting is to have this experiment and then we can see how they respond to it. And these are all endogenous responses to this change. Yeah. Okay, in terms of results, here's the impulse response for cash on hand. This is in response to an increase in 100 basis points in the aggregate rate over the length of my expiring deal. So in the pre-period, there's very little action. Then around the time people get the chance to refinance, the rates, cash on hand starts to come down. And then after 12 months, it's about £2,000 decrease in cash on hand in response to this 100 basis point increase in mortgage rates. I'll decompose this later. In terms of sources of variation, this is an important question. Our baseline there is looking at a year fixed effect and a sort of age fixed effect. So the year fixed effect has sources of variation, including 2-year versus 5-year deals. There's a natural concern around that. People who choose these do not choose these randomly. So what we can then do is then use deal times year fixed effects. This is relying on the idea that there is actually some variation in exactly the length of a 2-year deal, for example. And if we then look at that, two people on both 2-year deals expiring at the same time, we get very similar answers in column 2. So that's one source of variation. Another thing we can do, which is very nice, and James did as well in his papers, is use household fixed effects. Because this market turns over quite quickly, you can see the same household refinancing multiple times over time, and then take out all the kind of unobserved time invariant heterogeneity at the household level. Look at the same household experiencing rate changes at different points in time and see how that drives the variation. And it's very similar again. And then finally, we can look at this, looking at two households whose deals expire in exactly the same month and just focus on the variation due to the length of the deal. Across all these 3 sources of variation, we see very similar answers. And that's overall what gives us confidence in the external validity, or sort of internal validity of our results. I'm going to skip over this. On to...
heterogeneous? It's all in growth rate space.
No, so it's taking out, so there's a liquidity effect. So I get this chance to unconditionally adjust my borrowing when my deal expires. And then then there's a component due to interest rates. So taking out that component. So like perhaps every time you refinance, you take out some money. It absorbs that for the individual. That's what's absorbing. Here's responsive consumption. So again, consumption, there's no penalty for adjusting consumption in advance, but we're actually seeing perhaps liquidity constraints. Consumption is not responding until deals start refinancing. And then after 12 months, consumption has fallen cumulatively by 5%. Just to emphasize, this is a fall in cumulative consumption. This is adding up the changes. We can do it in flows as well, but it's a similar sort of idea. Back to this question of MPC. Our MPC here is the ratio of one to the other. It's this marginal propensity to consume out of cash on hand. This is about 0.7 after 12 months. So about 70% of what you had as experience as a change in financial resources is then consumed within this window. And then the rest of it is being saved, maybe spent after this window. Again, this is not the MPC out of a transitory income shock. This is the MPC out of this change in cash on hand. Right, okay. We do a lot of stuff in the paper, additional stuff, which I'm very happy to talk about. But in the 5 minutes left, we want to go on to borrowing and the role of asset prices. So one question is, what is driving cash on hand? A lot of focus in literature has really been on these cash flow payments and changes in debt service. One thing we can do just is decompose these two parts of cash on hand. We see borrowing at the bottom responds essentially immediately and is then pretty flat, whereas the debt service term, as you'd expect, cumulatively builds over time. It changes once, and then the effect of that just keeps building over time. So one result here, first of all, is that the response of borrowing is actually greater than cash on hand. So even just mechanically, it seems like it might be a more important part of this cash flow channel. Our question is then to go into why is this borrowing response so large? And what we do here is we use cross-sectional variation. Our eta here is an average response by region. We have 360 regions in the UK. Within each of them, we look at the average response of house prices to rates, and we then plot on the y-axis in those regions on average, how does borrowing respond? At the intercept there, this is an area where house prices do not respond at all. This could be driven by the IES, or it could be driven by wealth effects from future changes in cash flow payments. And that sort of magnitude there is actually very similar to James's paper estimating the IES. But then as we come down, we're seeing in these other regions, there's a greater response of borrowing when house prices respond more. And overall here, about 50% of this borrowing response is being driven by house prices, just comparing essentially the intercept with the average, just as a kind of rough metric. So comparing this at 500 with 1,000. Of course, this is not instrumented or anything, but we then use in the paper two sets of instruments, one building Adam and Emmy and John's paper, using land supply elasticity across regions, and then one, which is more novel for us to use, is within regions, looking at the variation in the duration of the housing stock in the UK. So to tie some of these things together, here, without using an instrument, looking at the response of cash on hand, we group this into three buckets here. Relating to one earlier question in terms of fixed effects, what I'm actually using here, I'm using deal length times year, so two people with deals of the same length expiring at some point in the same year, and then times region fixed effects. So that is absorbing all contemporaneous things happening in that region at the time of deal expiration. So you might worry about changes in rates affecting the labor market or anything in that region. That is being absorbed in a contemporaneous way. What we're exploiting here is this variation in the rates I'm facing, and then also this variation in the responsiveness of prices to rates in that region. And if we then go into columns 3 and 4, just looking at borrowing here, this is just sort of representing what we see in the picture. In the least responsive regions at the bottom, you're seeing about a £500 decrease in borrowing. In the average region, it's about £1,000. That is, again, kind of being used, they're suggesting about 50% of this borrowing response is due to prices. If we instrument this regional eta, we get a very similar answer. Adam?
Look at the asymmetry.
Yeah. Yeah, we looked at this. Here's our bin scatter. I skipped over it. We don't see asymmetry. You could tell reasons for this. One is people tend to always be borrowing a little bit. And then there's not really this one zero distinction between borrowing and not borrowing. But this is what we find. Certainly the rate hike versus the decrease is very similar. I want to quickly talk about duration, if I have a second. We see similar things for consumption, I should say. So duration, the idea we're exploiting here is that in the UK, you can own your house in two different ways, both leasehold and freehold. Freehold is where you own your house in perpetuity. Leasehold is when you own it for a finite period of time, for like up to 125 years, for example. And that creates nice variation because the freehold is infinite, sort of like infinite claim on a discounted stream of rents, whereas the leasehold cuts off at a certain point in time. So these longer run rates are going to actually affect the price of the freehold house, but not the leasehold house. And that gives you regional variation, sorry, within region variation.
Leaseholds legally required to be transferred into freeholders like 10 years before the end of the
No.
contract.
No. There's questions around people, I mean, well, Joe's smiling because Joe and Atif have a whole, and Veronica have a whole paper on this, looking about how you can measure the long run housing yields from what happens when you extend leaseholds. But we can be looking at this like people quite far from that extension point. But yeah, I think we can park those questions and Joe can explain things afterwards, perhaps better than I can. What we can do though with leasehold and freehold, which is nice, is that these occur in the same region, they could be in the same street. It's a way of owning a house, not a type of house as such. What you can then include is start month times end month times region fixed effects, absorb all the variation in that region over that time period, and you have this gap between freehold and leasehold as the remaining variation. The column 1 here is looking at the impacts on borrowing. What we see here is that freehold houses see a £800 greater decrease in borrowing for this 100 basis point increase in rates. We can look at this in terms of house prices. On this first stage, freehold houses within the same region see a 3 percentage point greater decrease in prices due to this increase in rates. And if we then create an instrument from this, we then get this marginal propensity to borrow out of the increase in home values of 4 pence on the pound. And we get the same with different instruments. I think I'm probably very short on time, but just to say here, as I said, we can also look at the impact of house prices on monthly payments. It accounts for something, there's some impact of house prices on individual rates and then on payments. It is not as large as for borrowing. What it suggests to us is the borrowing response it looks more like a world of collateral constraints. We look at this in the paper as well, and this borrowing response is greater for borrowers who went into the higher loan to value ratio to start with. So it's more suggestive of sort of Kiyotaki-Moore world. Okay, and with that, I'll conclude. So just take away a few messages here. This paper is estimating how rate cuts affect consumption via the household debt channel. Again, this direct effect of rates on the household, abstracting from these GE movements on income. We're exploiting two things: merged mortgage consumption data and also these natural experiments, both in deal expiry and then in this house price sensitivity to rates. 3 things to take away: household debt channel is large, borrowing accounts for the majority of it, and the consumption response, and then asset prices count for a large share of this borrowing response. Thank you.
In the UK, does the cost of carrying a house fluctuate up and down with the house price?
No, we don't have land taxes.
So property taxes don't
No.
vary with the house price?
Well, so in the UK, it's an interesting system. They have council tax, which is essentially like a property tax, but within that, the property values are fixed at the value in 1991. I don't have a micro foundation for that fact, but there's been.
How about insurance costs? Do they fluctuate with the price of the house?
Not typically. The insurance costs, no. Yeah.
Just for you, what would be the theory that leads to the consumption goal to go down? And if you turn all of the different kind of hypothesis and you find your regression, do we expect NPC equal to 0? I think that a benchmark for.
Can you say that again? So what about the model? Beyond, I mean, maybe.
Yeah, so this is, I mean, it's almost just an invariant position. So even in the, so I guess maybe you go to the next one. Even in the permanent income hypothesis, well, decomposition like it's gonna hold. If you have only one asset, the NPC out of capital is guaranteed to be 1. And it's, yeah. And so it's just, I mean, really what this is saying is that an NPC of less than 1 just means that you take what you're borrowing out your mortgage, you spend some of it, maybe you pay out to very hard, whatever.
Answer that. It feels like we are going through the translation back on cash on hand, and it sees out cash on hand, which obviously is typical way of think about and see the for the shots. But in this case, it seems like the agent is facing a change in interest rate going forward, so two things have changed. Regarding value, but also interest rate. I think the useful thing about it, like, suppose I had an asset, and then what you found out is that the interest rate of the asset is permanently changed. How should you change your consumption? You know, permanently consumer will change the consumption, or should change the moving values of wealth, we should just change the interest rate. So in other words, have you been interested to ask, basically, does consumption move by the amount of the interest rate or not? And if the answer is yes, it's actually pretty close to the age thing.
That's a great point. And in fact, if we use that to combine all these NPC questions. In terms of AD, NPC is actually not very interesting. So that's why I think some of the emphasis we show it because we can measure it. But related to what you said, the more relevant measure is NPC out of wealth. That's the sufficient statistic that we really care about. And like exactly like you said, it's greater than the interest rate or less than interest rate, that's where it gets interesting. So we do spend a lot of time estimating that, and Angus mentioned that in the beginning. We didn't have time to show you the tables, but we get a number that is around 4 cents to $1, NPC out of wealth. And I want to emphasize that everything in this paper is going through the interest rate channel. So when I say the NPC out of wealth is 4 cents on $1, it's wealth change that is driven through the interest rate shock, right? And so I think that's the key number that as you how to map this to PI versus other Einstein models, that's what the number that's most relevant.
That 4% versus the average interest rate. It's like
Yeah, exactly. For that depends on which question you're interested in, right? But that's to take number to the model, because obviously we're not doing like, but if you think about homothetic versus non-homothetic like that, I think you would want to.
Sure, I worry about the durable part of the consumption, because I mean, you need just a little bit of a friction and you're gonna time when you get your new washing machine, this kind of thing.
So none of that is an issue here, so I'll just explain why. The key variation, both control and liquidity are getting the liquidity in them. So they are both buying the washing machine. The question is who buys more washing machines or a bigger washing machine. So both control and treatment are getting the refinancing shock. So they're both getting the liquidity shock. So none of what we're estimating includes the pure liquidity effect. Because obviously that's not driven by the interest rate.
There's a second round thing, if I want a nicer washing machine, I get more cash on it.
So that is driven, it's because of the interest rate change, which is what we want to have. So that's the way to interpret it.
You know, there's also an interesting empirical result, which turns out in the data, non-durables actually drive big jumps. So empirically, we're not too worried about this, even though you can see it.
Last question in the back.
What and the second thing is regarding the model has question, see the level consumption and you activate as those people will have mortgages for generally user and without mortgages. You can activate if you show us now which effect with a much bigger result from these two channels because it allows this control spectrum. If you show all this change, you can levels as well.
So this was really interesting. So I think the thing I want to say most about aggregates is if you take our number and the back of the envelope way, extrapolate it up, it's going to be of a similar order of magnitude, pretty similar to just the overall aggregate effects of market jobs. The aggregates be important.
Okay, I think we should move on to the next paper. Let's give these authors a round of applause. And was going to be the last speaker of the day.
All right, thanks a lot for having us. So the title of the paper is Bank Runs with and Without Bank Failure. And this is joint work with Sergio Correa and Stefan Luck. So the broad motivation for the paper is that bank runs are obviously a salient feature of many financial crises. But I think it's fair to say that their causes and also consequences in crises are subject to long-standing debates. So for example, Blanchard's comment in 2018 talks about these sort of different views of runs. So one view is that runs should really be seen as these kind of self-fulfilling jumps to bad equilibria, where even small shocks or small changes in expectations can lead to severe crises. I mean, Friedman and Schwartz's account of the Great Depression very much has this flavor. Kind of an intermediate view is that runs should be seen more as an amplifier of deteriorating fundamentals. And a third view, which is perhaps more extreme on the other side, is that runs are really more a symptom and a consequence of deeper solvency problems that are at the root of the crisis. So, one challenge for sort of understanding these different views is we don't have that much systematic micro-level evidence on runs. So in particular, there's a broad literature that focuses on bank failures, which are objectively recorded legal events in historical records. But this is going to miss runs without failure, and you don't necessarily know, which failures actually involve runs. A second approach is going to use very, granular data, often nice data, covering runs on, one bank or a few banks. So here, what you're going to be able to see, for example, is the behavior of depositors in one specific run, but that might be harder to generalize to sort of know what are the broad features of runs during crises. And then a third approach is going to look at aggregate narrative data on banking panics. This has sort of been very influential. Here you have many different episodes, but you have less bank level, you don't have bank level information, so you can't say something like which banks were subject to runs, did the banks that were subject to runs survive or fail, and so on. So what we're going to do in this paper is we're going to bring novel large-scale evidence on runs. So in particular, we're going to apply textual analysis and large language models to US newspapers from 1863, so the start of the national banking era, until 1934, which we choose as the end date, the introduction of federal deposit insurance. So this is going to give us a nice sample where we have, a historical laboratory where there were lots of runs before the introduction of deposit insurance, and before 1914, there's no public lender of last resort. And this is going to give us a data set of 3,984 runs on individual banks that we can then study. So here's one example. On the right is the run on the Fourth National Bank in the panic of 1873, one of the famous runs at the time. And then we can use this data set merged with information on bank fundamentals that we've also collected to study kind of very basic questions. First, what are really the determinants of runs? Second, when do bank runs result in bank failure? And third, what are their consequences for lending and for the broader real economy? Let me just summarize the key findings. Anil, you had a question?
Yeah, right. There were a lot of collective insurance schemes amongst the banks.
Yes.
And
Clearinghouses.
So those clearinghouses, there's basically no failures amongst the members of the clearinghouses. So is that just wrong, or are you going to tell us that there are sometimes runs against members of clearinghouses?
Oh, there are certainly runs against members of clearinghouses. Then clearinghouses would intervene. Often what they would do is they would come in and they would inspect the banks. If they thought that the banks were solvent, they would lend to them. If they thought that they were insolvent, they would let them fail. And that's sort of going to be one of the key mechanisms for why lots of these runs don't end in failure. I'll show you.
House is not a great predictor of no run.
1907 is the perfect example of that.
Well,
It was a huge run.
Yeah, but it was among the non-members.
so what happens, I mean, we can talk, we have 4,000 runs, so we could, spend 45 minutes and go through each one of them, right? We kind of give you the systematic evidence on all of them. For 1907, there's runs on the banks and the trusts. The banks basically survive because the clearinghouses provide liquidity, and then the clearinghouse decides not to save the trusts, and a lot of the trusts end up failing. So we can see actually all of that, and I'll show you, for example, actually in the paper that, if a bank is subject to a run, if it is a member of a clearinghouse, it's less likely to fail, conditional on having runs. We can kind of compute all of those statistics. Let me give you sort of some of the key findings. So first, I'll show you that, not too surprisingly, runs are more common in weak banks, consistent with theories of fundamental base panic runs, but they can also occur in banks that look ex ante quite strong. And this happens especially after bad news, either about the macroeconomy or about the local banking system, consistent with sort of asymmetric information theories of runs. Second, when we think about which runs actually pass through into bank failure, I'll show you that runs really usually only trigger the failure of banks that look observably weak. In fact, I'm going to make a stronger statement. I'm going to argue under some assumptions about how much value is destroyed in failure, that most banks that fail, that were subject to runs, appear to be fundamentally insolvent. And in fact, strong banks can survive runs through a range of different mechanisms, like, for example, clearinghouses, but also other mechanisms like, new cash injections from the owners, or, interbank borrowing, not necessarily through the clearinghouse. And then third, I'll talk about what are the consequences of runs for lending in the real economy. And I'll show you that indeed runs are associated with contractions in local deposits and credit and manufacturing activity, but only when they occur in weak banks and only when they're associated with bank failures. So runs on sort of relatively strong banks really don't have these adverse effects on the economy. So the overall takeaway is that these poor fundamentals are central to explaining when runs occur and when they have severe negative economic effects, sort of tempering a little bit the view that you can have these large jumps kind of to bad equilibria purely through self-fulfilling runs. So let me talk a little bit about how we construct this data. Actually, in the paper, we have a lot of details on this. It turns out you can't just ask ChatGPT, give me a data set with a complete set of bank runs. You actually have to do a little bit more work. So we actually spent quite a lot of time on this. Basically, what we do is we read 372 million newspaper articles from Chronicling America, which is a project at the Library of Congress that has digitized historical newspapers, and also newspapers.com, because in more recent years in our sample, there's still copyright on some of the newspapers, so we have to go to commercial sources. And what we do is we classify episodes of runs, suspensions, which can be either temporary or permanent, reopenings after temporary suspensions, and failures, which are permanent suspensions. And basically what we do is we start by filtering these articles through a range of keywords that are related to banks and bank distress events, like you might have a bank a run mentioned, or heavy withdrawals or panics. Then we apply kind of a cheap off-the-shelf LLM to weed out kind of the most obvious false positives, like sometimes there's a boat that runs into the riverbank, not about a bank run. We don't want to have those in there. And then we have kind of a sample of newspaper articles that are about runs or other events on specific banks. Once we have that, then we use a series of large language models to basically map these articles into bank-specific episodes. And for the purposes of this talk, there's sort of three main types of episodes that can happen. One, there can be a bank run, but nothing else happens. The bank basically weathers the run. Second, there can be a bank run and then a bank suspension, but then the bank is able to reopen after a temporary suspension. Or third, there could be a bank run, the bank suspends, and then it fails, by which I mean it goes into receivership or some other resolution process. Anil?
Yeah, sense from what you might have looked at about how many zombie banks should have been run on and should have failed and never experienced run. Either they just fail outright or they live
time. In our previous paper on failing banks, we actually showed that a lot of bank failures are quite predictable based on bad fundamentals, which looks like, oftentimes depositors are sleepy and don't run on banks. I'll show you that, I'll show you most failures actually don't involve runs, even though they involve low recovery rates in receivership, suggesting that depositors probably should have run faster. I think that story has a lot of truth. If you think about, for example, the bank holiday, basically 3,000 banks were closed during the bank holiday. Presumably a lot of these banks were insolvent. Why weren't they run on, 1 or 2 or 3 years before that? So I think that story has some truth to it, even before deposit insurance. Yes, Josh?
One, your analysis, how's the bank decline? And
right.
Two, they're worried that the LLM knows the outcomes. And so maybe if the LLM is telling you what's their bank from during the Great Depression, and it knows that it's during the Great Depression, it knows that bank failed, it's more likely that there was no run than in a case where it knows that the bank did fine, and the economy's doing well, then it's doing.
That's a good. So on the first question, how is a run defined? Basically, we define a run as an episode where there's a severe and sudden sort of demand for deposits, for the bank to convert deposits into cash or the deposits of another bank. Then, in practice, we ask the LLM basically to look for any kind of observable signals of kind of those sudden withdrawals. I'll talk about validation in a little bit. I'm not too worried about that type of sort of look ahead bias. I think, generally newspapers were quite clear about, when they thought there was a rapid drain or not. And in the cross validation exercises that we've done, I think the performance is quite good. basically, we don't ask the LLM to take into account any other context than the exact newspaper articles that we give it. Yes.
Just to follow up on that, I think recent work has shown that LLMs do take into consideration in, other contexts than, for example, the FOMC statements. So it is an issue because, it's a big black box and we don't know.
Yeah. Okay. Let me talk about validation because we spend kind of a lot of time on that. Yes.
How does the language model distinguish a proper run where like basically I'm pulling out my money because there's fear of insolvency because other people are pulling their money from like the natural losses or from of deposits just because somebody's using the funds.
Yeah, so here basically what we're gonna look at in newspapers is basically any discussion of sort of a sudden withdrawal of funds. If it's a sort of slow drain of deposits, that's not going to be in newspapers.
Big company would have, say, Carnegie have a concentrated cash in a particular location. This is like, 100 years ago, where you would park cash wherever you're gonna pay your workers. And then suddenly you decide to buy something else somewhere else, take your cash out. How do you distinguish that event from a liquidity event from a run?
We're not going to distinguish those two. I mean, we're not going to talk about the motivation of whether the run is, say, because of strategic complementarities or a sudden demand for liquidity. We're going to look at basically all these episodes in which there's a sudden demand of funds.
But the event has to be in the newspaper.
The event has to be in the newspaper, yes. Yeah. So, yeah. Yes. Yeah, we do see some of that. We can see in local banking markets that, when one bank looks weak, there can be a run and then deposits at other banks can rise, but not necessarily offsetting kind of the overall, fall in deposits at the initial bank. I'll get to that. Yeah. Okay. So then what we do is we merge with national bank call reports, which we've collected from our previous paper. So we basically have, bank specific events on runs, and then we have bank fundamentals. So runs were very commonly discussed in historical newspapers. Here's a range of different examples. So, the Panic of 1884, this is a pretty famous run without bank failure on the Second National Bank in New York. On the right here, I have the run and closure of the Bank of the United States, which was, prominently discussed in Friedman and Schwartz. And on the bottom, you see Milton Friedman outside of the historical headquarters of the Bank of the US. So we do extensive, cross-validation of our data set against a range of ground truths. So we have 4 ground truth data sets. The first is Elmas Wicker sort of famously read historical newspapers to write his 2 books on the banking panics of the Gilded Age and the Great Depression. And so then we reread Elmas Wicker and basically classified all the events that he had classified and did additional research in order to have a ground truth of those runs during those famous panics. For national banks, which is going to be a key part of the sample, there's 34 runs, and we match 94% of them. We match 100% of the failures in Rockoff's EHA presidential address. Then we paid 8 RAs at MIT to spend a month collecting runs on newspapers.com, which is a slightly broader sample than the Chronicling America data set. And they were able to find about 230 runs, 87 of which were on national banks. And our approach is going to match 94% of those. So we have sort of a match rate of roughly 94 to 100% across these different data sets. We also match kind of well-known regional and national banking panics, for example, collected in the paper by Andrew Jalil. For failures, we can see the deposit outflow in the last call report and at suspension. And we see that failures with runs have 5 percentage point larger deposit outflows, sort of consistent with the idea that we're capturing the runs that were associated with failures. I will mention one caveat, which is, as John said, they have to be in the newspapers. We do see a little bit of a bias toward larger banks that were more newsworthy types of events. So in the paper, we kind of go through and check that the main results are there for the largest 20% of banks. And finally, we've documented all of the runs that we found online. You can go and read through all of them, which I haven't done, but I've read through about 300-400 of them. And generally what you see is that these LLMs perform quite well, conditional on you giving good inputs. So if the newspaper article has kind of informative inputs about a run occurring, then we find that actually usually the LLM does better than, for example, us or research assistants in classifying the events. Yes.
All positives here. I mean, if your LLM classifies any and everything as a one, you're gonna have a very high match rate.
Yes, so basically, so what we've done is for the sample of runs, for national bank runs, we have 1,200. We picked a random sample of 300 of them, and we've been actually working our way through them. And we have a false positive rate that's something like 3-4%. And most of the false positives are really borderline cases where the newspaper says there was some drain on deposits. And usually it's because the underlying article is maybe not a very high quality or not that informative. Not so much a problem with the LLMs. In particular, one thing I should have mentioned is we use an ensemble. So we'll use 3 different models from GPT, Gemini, and DeepSeek. And then if they disagree, we hand check those. So we kind of have a lot of layers in there to make sure that we're not getting these false positives. I'm a little bit more worried about kind of false negatives, where sometimes newspapers might just not report that a run has happened. Yeah, Emmy?
I was thinking about as well, sources are also part of, or other related sources are all training data. And so, effectively, the validation, it might not just be based on what you
That's right.
wanted to look at. It might
On those
also be
newspapers.
like articles that
Yeah.
say this, that talk about this, and then and
Right.
that kind of makes it a little bit less pure exactly how the determination is being made. I don't know how.
That's true. I mean, yeah, so,
States.
right, yeah.
But I is presumably don't suffer from that, right? Your hand collected doesn't suffer from that.
At hand collected, I mean, I didn't observe every single instance that they never used AI at all to collect them, but that's, yeah.
Covers this concern.
Yeah, so there we have a sample that's purely human collected. Then you get back to the false positive type of concern. But at least we're matching those events there. Yeah.
So you mentioned this briefly. How worried should I be that there are lots of runs that just aren't newsworthy? Because I guess runs that get resolved quickly, no problem. They might just not show up in news. I guess that's going to introduce some kind of bias, probably in your paper.
I mean, what you see is that there's thousands of local newspapers, and these events were really quite important. When the banks failed, you see, for example, in the distribution of deposit outflows, that these are in red, the failures with runs have substantially larger deposit outflows when the banks failed. So these newspapers were more likely to talk about that. But yes, it could be the case that we're missing some runs, especially for a very, very small banks. So kind of in the control group, in the control set, we might have kind of some banks that were subject to runs that are not reported. But again, we're using kind of the narrative approach, and I think this is at kind of a really industrial scale. And this is basically I think we're doing the best we can given the available inputs that we have that we can learn about in this history.
So, sorry, the hand collected stuff, are the RAs, I mean, one thing the RAs could do is just, find the most obvious runs, but that wouldn't really tell you about the kind of the vast
Yeah, so
harder.
So I think the obvious runs are really very much in sort of wicker, because those are the panic episodes. So the idea with the RA collected runs is we gave them an account, newspapers.com. We gave them a set of keywords, and we said, go through and basically find the runs that are in those newspapers on newspapers.com. Of course, some of them might be the more famous runs, but it actually overlaps relatively little with the wicker sample. So that there's a lot of runs that aren't in the wicker sample there. But it is true that we're going to be more likely to be kind of capturing the more newsworthy types of events. Okay, so as I mentioned, we have about 4,000 runs in this data set. And here's kind of some of the initial results that we have. So what you see is that of these 4,000 runs, about 1,400 are really run-only events. So the bank runs, but it doesn't suspend, and it survives and carries on. For 600 of them, the run leads to suspension, but then a reopening of the bank. So the bank doesn't fail. And for 1,900 of them, the bank is subject to a run, suspends, and then fails. So what you see is that a slight majority of runs actually don't involve bank failure. Then when we look at suspensions and failures, you see that there's lots of suspensions and failures where there's no newspaper discussion of a run, sort of suggesting that most failures don't involve runs. In other words, runs and failures are not the same thing in the sample. This is the figure over time. You see, we're plotting all runs without failure, and runs with failure for national banks where we have a census of banks, so we know exactly how many banks there were. And we're picking up the major panics of the national banking era, and the Great Depression. And you see really many of these panics during the national banking era featured lots of runs without failure. So where the banks survived, then during the Great Depression, there's more runs with failure, relatively speaking. That's sort of consistent with what our expectation would be. So now let me get into sort of the main results and talk about the determinants of runs. I'm going to construct a simple summary metric of sort of bank health. I'm going to call fundamentals. It's basically from a regression of the predicted probability of survival based on financial statements. So a bank's capitalization, its recent profitability, and its reliance on relatively expensive non-core funding. These are metrics that have been used to forecast bank failure well in previous work, including some of our own. Then what I'm going to do is I'm going to put banks in deciles of their fundamentals. And what you see is that banks that have poor fundamentals are more likely to be subject to a run. These numbers, however, are not that big. So for example, a bank in the worst decile of fundamentals has about 115 basis point probability of being subject to a run over the next 365 days. And that falls for banks that look relatively strong on their fundamentals. These banks can also be subject to runs, but these runs are less likely. When we then look at sort of how do we explain these runs on relatively strong banks, well, they're clustering in periods and areas where there's bad public signals, either about the macroeconomy or about the local banking system. And so when we, for example, examine how predictable are these runs, when we combine bank level fundamentals with these bad public signals, actually all of a sudden the AUC in this predictability becomes reasonably high. So we can sort of explain runs with basically these two sets of theories. So fundamental based panic run theories and asymmetric information theories. So then a key question is, when do these runs actually result in bank failure? Bank failure is presumably an important mechanism through which these runs can lead to real adverse consequences for the local economy. What I'm going to do is I'm going to estimate basically the pass-through of runs to failure in daily data. So I know that the day that a bank was subject to a run, and I know that the day that the bank enters receivership. So then I'm going to estimate basically the probability of failure, for days after the run. And this is what you get if you do that. So you see, on the day that a bank is subject to a run, then over the next 30 days, the probability of failure rises to about 38%. So basically what this is telling you is that a run is associated with a substantial increase in the likelihood of failure. At the same time, actually, a run is not a death sentence. In fact, 2/3 of banks actually survive runs in this sample. Yes?
Think about how long the fundamentals have been crummy. Somebody's been, in the dumps for 5 years.
Yes.
Much like fail.
Absolutely. So we actually have in the paper, in the appendix, and also in our earlier failing banks paper, we have sort of the evolution of fundamentals in event studies for 5 years before. And what you basically see, and this is going to be consistent with kind of the evidence I'm going to show, is that runs with failure are associated with these gradual deteriorations in profitability, in bank capitalization, rising non-performing loans, and that sort of happens relatively gradually over time. And then happens in failures with runs, but also failures without runs. And what you see is that the failures with runs, they just look like they maybe accelerate failure by a year or so. But actually, these fundamentals have been deteriorating for a while.
So you only have some, you're saying that.
Well, they take a few. They take a few years, yeah, and then they're run, yeah. Yes, so that's going back to the earlier Venn diagram. So actually, most of the failures, right? So most of the failures that we have, so in order for you to fail, you have to suspend, and so most of those actually don't involve bank runs. Only about something like 15% or so of the failures actually involve runs. We can, for national bank failures, we actually know the extent of the deposit outflow, and so you can define failure also based whether there was a run based on the deposit outflow. And there we see that the average deposit outflow is about 12% in the year before failure. So these banks are losing the
run label from a regular deposit outflow.
So here the run label is based on is a narrative approach. So it's based on whether the newspapers talk about there being a run or sort of a sudden drain in deposits at the bank. So that's different from sort of a bank kind of having a gradually deteriorating business model in which it's losing deposits. Yeah.
So the banks with the lowest fundamentals there in the green line, they have a 1% chance per year of a run.
Yes.
But your answer to Anil was that they have a much higher than 1%
Yes.
chance of failure.
Yes. Failure is much more predictable than runs based on fundamentals. Actually, if you put failure there, the probability of failing in the lowest decile is about 10%. So failures are substantially more predictable. You see this also, for example, if we just look at the AUCs in the first column, you see that, runs based on bank fundamentals have an AUC of like 69%, but failures have an AUC of 87%. So failures are really predictable. Runs without failure are very weakly predictable. Runs with failure are quite predictable based on bank fundamentals.
10% still means you have zombies for 10 years.
Yeah, I mean, this is a coarse measure.
They were dead 5 years ago, and then they get around and run. You're saying, things start getting bad.
Yeah.
Lots of times they recover. You get 3 negative shocks in a row, and then.
Yeah.
And you tip over.
And then you tip over, yes. I'm fine with that, yeah. So let me talk about, when do runs actually translate into failure? I'm going to show you the same estimates, but now looking at banks across their ex-ante fundamentals. And so what you see is that banks that have very weak fundamentals in the lowest decile of fundamentals, if they're subject to a run, they fail in about 60%, a little bit less than 60% of cases. If you're weak, so bottom tercile of fundamentals, you fail it following about half of the runs. Whereas if you're strong, so top tercile or very strong, you fail in about less than 10% of runs. And so you see this across the full distribution of bank fundamentals. Basically, both the probability of a run and the probability of failing conditional on a run, falls very sharply in this bank failure, in this bank fundamentals distribution. And I should just note, this is an imperfect proxy. Banks weren't required to provision for losses. There's lots of fraud amongst these banks. Banks can be subject to sudden shocks, and nevertheless, we can rank banks, predict pretty well which of them are going to fail when they're hit by these runs. Yes, Josh?
This is causal or in parts of reflecting other things that like bank fundamentals are bad during the Great Depression.
Yeah.
Part of what I'm seeing here is that like runs lead to failures.
Well,
during
what-
the Great Depression more than they do at other times. But maybe it's not with bank fundamentals, because during the Depression, people, a run predicts future deposit withdrawals in a way that it doesn't at other times.
I mean, I think, this series of facts that we're showing is basically that most runs are a consequence of bad fundamentals. And then if you have very bad fundamentals and you're hit by a run, you run out of cash, and that's when you're put into receivership.
Say the bank fundamentals.
Of course, yes.
So should I think of this as like a bank is bad fundamentals and that causes more like failures to become more likely after a run? Or the bank is bad fundamentals during the Great Depression and runs lead to failure during the Great Depression? We can talk about that.
Yeah.
It seems like you could get at that by just looking at crop failure. So there must be a bunch of.
Yes.
Yeah.
Literally, the crop
Sure.
failed, yeah.
Yes. No, I think underlying what's driving this is that there's some bad fundamental local economic shock. We see, for example, that rising business failures at the local level or a drought that predicts runs, that predicts failures. Yeah. So I mean,
Negative funds. If you look at something objects, not the LLM based one indicator, but like logical health.
yes.
Would these look?
That was.
I know, but the bank fails. So is this, the bank goes, well, you didn't know this, you were looking or you were dumb enough not to run on me, but here I'm next. Right? And that's.
I mean, there's lots of other ways that banks can fail. So one, they can run out of cash because they're subject to a run, or the bankers who are subject to, in this context, double liability can say, you know what, we're going to close up the shop now so that we don't have further losses, or they're subject to examination. So the receiver can come in and say, you know what, well, we can't really do much to turn your business around, but we're going to force you into receivership, and so we're going to close you down. And so that's a very common way in which banks failed. So I think in some sense there's runs are only one of many ways that banks can be forced to close. Yes.
That's possible, but the balance sheet So could you also mention the positives?
Yeah, I'll show you, I'll show you that, yeah.
I guess the rest, that's what it's like. So, you know, for positives that have sense of sudden, whether if I really bad, that's the outflow, positives much bigger.
Yes, that you're anticipating about 5 slides. Yes, I'll get there. Let me talk first about non-fundamental runs. So we're going to ask this question, can it be the case that a run that's really not related to, say, bank health, but really some false information, can that lead to failure? So we can actually find, again, using these LLMs, a set of runs that really look non-fundamental. So there's 53 of them that we affirmatively classify as non-fundamental, and we read through all of them. On the right is one example. So there's a run here on the First National Bank of Minneapolis. Basically, the run happened because the German and Scandinavian papers announced its suspension by mistake for the First National Bank of Memphis. So basically, people ran on the wrong bank because there was some false information. So then we can ask, this is really sort of a relatively random set of runs. So then we can ask, what's the likelihood that those runs translate into failure? So for the average run, the probability was 38%. For a non-fundamental run, it's 11%. So these runs are much less likely to lead to failure, but it can happen in a few of these instances. Then we can ask, what if you have a non-fundamental run, but you have strong fundamentals? Then actually the strong fundamentals completely protect you against the run. So you completely survive these runs. And we can go through and read these cases where the non-fundamental runs were then followed by failure. And this is usually because these banks actually either were committing fraud or had hidden losses, and the run meant that that the examiner had to show up, and then they decided to close the bank. Sort of consistent with this idea that runs can be thought of as monitoring devices. We can then ask the newspapers basically, why do runs rarely cause the failure of strong banks? What do newspapers talk about for banks that survive runs versus fail runs? And what you see is that banks that survive runs, typically, they talk about accommodating withdrawals. They talk about borrowing from other banks. Often they talk about sending some public signal to depositors, like newspapers will talk about bringing in truckloads of cash to basically show that the bank is solvent. Sometimes the owners will put in additional capital or give a loan to the bank. And then in other cases, like we were talking about in the beginning of the presentation, you'll have sort of suspension and bank examination. And in about 10% of cases, the clearinghouse is involved, providing some type of examination and liquidity provision. Now I'm going to try to answer the question of, do runs trigger the failure of weak but solvent banks or insolvent banks? This is a hard question to answer. We need to make some assumptions, but we're going to sort of take a stab at it. So what we're going to say is, suppose that failure destroys some bank value mu. This could be because the receiver is just less good at managing the assets of the bank, or it could be because there's some loss in the franchise value. So then the bank is going to be fundamentally insolvent absent the run if the recovery rate in failure relative to the bank's leverage right before failure is less than 1 plus mu. So it turns out, so we have all of the data on the proceedings of national bank receiverships. In these receiverships, the asset recovery rate was quite low, 52% on average. The depositor recovery rate was 66%. So depositors basically had pretty big losses in these failures. So if we can play around with different assumptions on mu and say, for example, suppose the receiver is just as good as the banker at managing the assets, then that suggests that runs on solvent banks account for about 7% of failures. Whereas if there's lots of value destruction and failure, say 20%, then runs on solvent banks can account for about 20% of failures. So yeah, so basically debt relative to assets. Yeah, exactly. So this is basically the depositor recovery rate on the left-hand side. So what this is telling you is that most failed banks look fundamentally insolvent. The scope for runs to kill solvent banks is small, but it's not zero. So in the last part of the paper, we're then going to ask, what are the consequences of runs for lending and real activity? So this is going to go to one of the questions before about deposits. First, we're going to look at banks themselves and look at banks that survive runs, because then we can see their balance sheets both before and after runs. And these banks are, of course, very different from the banks that fail in runs. On the left here, I'm going to show you deposits in the years up to the run for surviving banks. And I'm going to split again by my fundamentals measure. So strong fundamentals, weak fundamentals. So what you see is that Banks that have weak fundamentals, they have a deposit outflow of about 7%, even if they survive, and they are sort of smaller banks in terms of their deposits for several years after the run. Strong banks with strong fundamentals, basically there's a slight downtick in deposits in these annual data, but really they recover pretty quickly. You see the same for loans as well. So banks that survive runs, they contract their loans, but really only if they have weak fundamentals. If they're strong fundamentals, they're basically able to continue at almost the same size as before the run. Then we can think about the consequences at the local level. So we know where all these banks are. Most of these banks are unit banks, so they'd be operating locally. And we can ask what happens to loan growth in the cities where banks are subject to these runs. Again, I'll split by runs on weak versus strong banks. And what you see is that if you have a run on a strong bank in your city, actually, there's not much that happens to loan growth in your city. So, basically the intermediation is not really affected. Whereas if you have runs on weak banks, then lending contracts by about 30%. This is sort of the combination of both failure and the reduction in lending for banks that don't fail but are weak. And this is quite persistent. So these runs would sort of trigger, when they happen in weak banks, trigger these persistent declines in local intermediation and also local deposits.
Probability of surviving rates change much?
If a bank is, so that we haven't looked at profitability specifically. So we do see that, yeah, if you're in a city and other banks are subject to runs, then your deposits go up. And so you become, so there's some reallocation happening, even though the aggregate effect is a decline in overall lending and overall deposits. But we could look at profitability. And then finally, we look at, what's the impact on local real activity. So to do this, we've collected some new data on city-level manufacturing activity from a trade journal called Bradstreet's. So what they would do is they would publish a weekly table called Trade at a Glance, where they would give sort of summary metrics of how well business activity was in a given city. We have this for 30 cities, and the nice thing is that it's weekly, and it's quite correlated with industrial production. So an R-squared of about 49%. Again, if we look at runs at the city level, if they're on strong banks, actually there's not much of an effect on industrial production, whereas if it's on weak banks, industrial production falls by about 5% based on this measure. And it's similar if you have runs with failure, industrial production falls, whereas if you have runs but the bank doesn't fail, then actually there's no real effect on manufacturing activity. Okay, so let me just wrap up here. I'm out of time. We have new data on about 4,000 bank runs. Runs are not the same as failure, and they're not the same as adverse real effects. Really, what you need is a combination of runs and weak fundamentals to generate failures and these adverse consequences. So really sort of, the broader view is that severe crises really start with insolvency and then, lead to these liquidity problems that might amplify the downturn. And so that obviously, places a focus on solvency-based policies in these crises. Thank you.
So let me ask the first question. So we had a little discussion at the beginning about the fact that in some times and places in your sample, there were these clearinghouses or other mechanisms for protecting banks against failure, even if there were runs. And I guess other times and places there were not. So I'm wondering if you didn't show us any results where you broke it down between those things, but I feel like that would be an interesting cut.
Yeah, good question. So what we have done is, so Matt Jaremski shared with us his data on which cities had clearinghouses. And we assume that national banks would all have been members of the clearinghouse. We can actually collect data on which banks were clearinghouse members from some historical documents. We're working on that. And what you see is that if you have a run, then you're about 12 points or so more likely to survive the run if you're in the clearinghouse. So again, sort of that suggests that if you're subject to a run and you're kind of on the border line between solvent and insolvent, the clearinghouse can provide liquidity and also maybe provide information to depositors that actually you're solvent and reopen the bank. So kind of those types of private solutions do seem to mitigate the costs of runs.
But I mean, one cost would be the failure, but I guess the length of suspension would also be another possible mechanism through which,
Yeah.
If you don't have a clearinghouse, then you might just have to suspend for a long time and
So that would be another possible cost, but
Yeah, I mean, we find that at the local level, the costs of temporary suspensions are quite small. Actually, this is the longest suspensions, I think, are 3 months in 1907, but usually it's much shorter than that. So, it seems the main costs are really when banks actually fail. Anil?
I mean, the pure diamond dipping thing is pretty extreme, but the idea that you might have a weak bank that somehow never gets detected and then others get run on, it seems like the right counterfactual to assess these kind of panic-based things is to find out how many banks have really crummy fundamentals and look like they shouldn't be subject to runs. It's like if you look at that Cipriani federal paper.
Yeah.
I mean, they make a big deal out of there were 23 banks that were essentially as insolvent as SVB, but only 9 of them had runs. And I'm kind of obsessed with what those 14 banks look like, whether that's just the normal state of affairs that you've got these really impaired banks. So to the extent you can do anything on finding guys that look like they should have been run on and weren't, and trying to learn
Yeah.
about that, I think that's be very helpful.
I mean, what we did in our previous paper is you see that these failures are very predictable. And then we, for example, calculate like based on the predictability that we have and the losses that depositors have in receiverships and the amount of time they have to wait, what would be like the required return that you would have under some different, and those look quite high for these very, very weak banks. So there are kind of these set of banks where they're losing money, they're relying only on this, non-core secured borrowing from other banks because basically no one else wants to lend them. And that's a clear sign of failure, and it takes some time before they're closed. So banks can be, basically liquid, but insolvent or very weak for some time. And then predicting when they're run and when they're closed is sort of a little bit more difficult of getting the exact timing. And maybe there's some behavioral or news aspect to that. Yes.
maybe it's for a different paper, but I think it would be super interesting to look at spillovers. Because we know that bank failures concentrate around periods of time. So one question is it a macro event that hits a ton of banks at the same time? Or is it that we learn about Lehman and then Lehman spills over to the next guy, and that's the reason why we concentrate? And I think because of this excellent data.
Yes.
Like
Yeah.
daily,
Yeah.
and also with the regional.
Yeah.
Information.
That's a great suggestion. And in fact, we are working that through sort of 2 spillover channels. So one, because this is, such a long time ago, news travels more slowly, and we can control actually where news goes based on syndication networks of newspapers. So we can sort of predict if there's a run, it's reported in some, newspapers, it's going to be more likely to report it in one city, but not another. And then the other data actually that we've collected is on the bank correspondent networks. And that's actually an important part of sort of propagating shocks across the banking networks. Is that, you'd have country banks that would have correspondent banks in the cities. And if the correspondent bank was subject to a run and failed, that was really bad for the country banks. And then you'd have those crises spread out.
So say what you find.
So maybe next summer. Yeah, next summer. Yeah. Yes, perfect.
Hazard rates. You need data on the non-failed, non-abandoned banks too, which you may or may not have. You didn't do that here. But something like, here's a probability of being run on as the bank's equity coverage changes, as the bank's liquidity ratio changes. It is a probability that the run will lead to a failure as these things change. It is a probability.
Yeah. So we can do that across different, I mean, you could think about this as basically a hazard rate, and there's a duration of, say, you could survive for a long time without being subject to a run, even in the lowest decile of fundamentals, but you're much more likely to fail through other means. Yeah.
I'd like to see this for a whole bunch of things. I don't know what the fundamentals are.
Yeah.
Right. What ways these things get. But if you tell me that, is it more important to see the capitalization of the bank or the liquidity of the bank? How important is this insolvency versus liquidity? You could turn that into a hazard rate, and that would be very informative and would answer a lot of the questions that were asked here.
Yeah, no, that's a great suggestion. We do some of that in our previous paper. I will make one point that I don't want to think about, say, the reliance on non-core funding as being necessarily about liquidity and capitalization being about solvency. I mean, usually what happens is these banks are subject to losses, and then they start losing, for example, some of their deposits, and they have to cover that. And so they go and they borrow through rediscounts bills payable from other banks, and that's a signal that you have a bad business model and you're losing money. So that's why I'm really cautious about sort of interpreting these different components of the fundamentals. But this is sort of a summary combination that is a very good predictor of bank failure with an, as I said, an AUC of almost 90% in the sample. Joe?
The intensive on these runs, how bad they are. Because I guess one maybe dumb story that's a little out of your thing is maybe the bank has strong fundamentals, they have these tiny little runs, the bank has weak fundamentals, the runs are really bad.
Yeah, sorry. Maybe I went too quickly, but this is actually getting at that. But ideally, if you had, say, daily deposit data like this Cipriani New York Fed paper, then what you could do is you could just say, well, I'm going to look at and define a run as when deposits fall by more than X amount. But in this sample where we actually have a lot of runs, the best we can do is basically annual deposit data. And so this is an annual data. So if you survive, but you have weak fundamentals, you lose about 7% of deposits. If you fail, you lose about 13% of deposits. If you're strong and you survive, you lose about, it's not significant, about 2% of deposits or so. So certainly there's also, heterogeneity in the severity of these runs that's well predicted by or captured by your ex-ante balance sheet strength.
Okay, I think we should thank Emil again and